Very good morning, friend. Good. And of course, the presumption which I always say that you've made your cumulative revisions on financial instruments. So today is the last lecture on financial instruments. I think we've come a long way in terms of starting from the very basics to the complex concepts related to financial instruments. Journey from Index 32 to Index 109. Now we are tackling some special agendas, some special issues which are addressed in Index 109, and we are discussing the concept of derecognition. We've already made our discussions on the derecognition of financial assets, and now we've started our discussions in the previous class on the derecognition of financial liabilities. And today what I have on the agenda is also to give you insights about impairment, also to give you insights about the concept of hedging, and also to discuss about the embedded derivatives, how the accounting of derivatives embedded in the financial instruments are accounted for. So we've got these three agendas, but before that, we've got one small little pending issue, that is derecognition of financial liability. So I think I had already given you some inputs regarding the derecognition of financial liabilities, where we were discussing the concept of what we call SDR, strategic debt restructuring, in which we said the companies may negotiate with the bankers when they are, let's say, not able to pay money, or maybe for any other reason, but it's not the intention not to pay. The intention is not to pay. The intention is not, of course, not to pay, but of course, asking for a restructuring where you are able to defer some payments. Now, this negotiations, this modifications in the original terms could lead to a variation which could be 10% or more than 10% as compared to the original terms. And therefore, we decided you need to decide and zero down that is it a case of modification accounting or is it a case of extinguishment accounting? So I think let me first make a quick mind map on the inputs which I gave you. That is what we called a 10% test. In terms of the 10% test, we will zero down on the fact that when do we apply a modification and extinguishment accounting? Now, how does a modification accounting or an extinguishment accounting takes place? That, of course, we're going to study with an illustration. But first, let's make a small little mind map to you. So I'm just making the mind map on the derecognition of financial liabilities. So we are focusing on the derecognition, but that's also derecognition in terms of financial liabilities. Needless to tell you, but I'm just reminding you, derecognition, of course, means removal of the financial liability from the balance sheet of the company. So in this case, we decided that there is going to be a 10% test. It's a materiality test, and therefore we call it as a 10% test. Now, what we need to do in terms of this is apply a simple three-step model. Remember, this model is only going to decide which kind of accounting is going to trigger, nothing more. So we can say the step number one is we need to consider the present value of original cash flows discounted. This is discounted at original EIR. So there are two focus points in terms of this. One focus point is that we're looking at original cash flows. And of course, we're looking at the remaining cash flows. So whatever is the remaining cash flows, we'll consider those remaining cash flows, and they are discounted at the original EIR. So two focus points need to be very clear. That we need to consider the original cash flows, and we need to consider the original, you can say, EIR. Then the next step is we need to identify the present value of, you can say, the new cash flows, and this is again discounted at the original EIR itself. So in this particular case, the focus point is the new cash flows and of course the original EIR. So what we need to remember in this particular case is that we are using a same effective interest rate in this case. The discounting is done at the same rate itself. So the only difference is the timing factor of the cash flow, which is going to vary in these two cases. And of course, what you need to also consider in this case is, along with this, we'll also add any TC. So when you do the step number 2, just remember that you also need to consider the present value of the transaction cost, which of course is incurred at time 0. So that would not be requiring any discounting. And then you go to the step number 3 and you calculate the percentage variation. You calculate the percentage variation, take the difference between 2 minus 1, that is the figures in step number 2, minus the figures in step number 1 over the base of 1, and you calculate the percentage variation in this case. And we decided that the percentage variation could be 10% or more. So this includes 10% as well. We've said that it is 10% or more. So the variation is exactly 10. Then also it is covered 10% or more. In this particular case, we apply what is called extinguishment accounting. So in this particular case, the accounting which is applicable is called the extinguishment accounting. And if it is supposed to be less than 10%, not even 10, but we are saying less than 10%, then in this particular case, what we apply is called a modification accounting. So what you need to keep in mind in this particular case is the inputs, that the 10% test will only help you to decide the kind of accounting. Let me overemphasize this part. The 10% test which you're going to conduct will only decide the fate which kind of accounting would apply. Am I going to apply the extinguishment accounting or the modification accounting is decided by the 10% test. So every time you see a question where there is a renegotiation in terms of financial liability, you need to first of all apply a 10% test to zero down on what kind of accounting is to be applied. And then how does the modification accounting function? How does the extinguishment accounting function? That of course we'll see in the question. What kind of entries will be done? That of course we'll see in the question itself. So that was a little mind map in terms of the principles, or you can say the parameters, which decides the concept of derecognition. I think now we're going to do some illustrations with you which are given in the study material in unit number 5. So one question I'm going to explain on extinguishment accounting, and the other question I'm going to explain is on modification accounting. So let's begin the journey. Okay, so let's go to the study material, and there is an example number 3 on page 11.164. I'm just going to crop this so that we can just clearly see the inputs. So this is an example which explains the concept of extinguishment accounting. I hope, friends, that is visible to you. Just let me know if this is visible, I guess. Good to go, I guess. Okay, so let me, I guess, read the inputs what are given out here. It says, on 1st January X0, XYZ issues a 10-year bonds for 10 lakh rupees, bearing interest at the rate of 10%, and the interest is payable every year on 31st December. So the interest is paid in arrears. The bonds are redeemable on December X9 for 10 lakhs, and there is no cost or fees incurred. So no cost or fees means no TC, no processing fee. So if there is no TC, there is no processing fee. That also tells me that the coupon rate of interest, the contracted rate of interest, and the effective interest rate is the same. And therefore, it says the effective interest rate is therefore 10%. So in this particular case, no TC, no processing fee, that leads to the conclusion that EIR and the contracted rate is the same. Then he says on January X5, that is after 5 years, XYZ and the bondholders agreed to a modification in which the terms are extended to December Y1. Now this is where sometimes people tend to get confused. Sir, what is Y1? Well, we are on the series of X1 and it got extended to Y0. Now it's simple. Y comes after X. So you can say after X9 will be Y0 and then Y1. So that's simple. So after the year X9, you're going to start with the series Y0, Y1, Y2, and so on. So when the original period of the loan is supposed to be on December X9 and it got extended till December Y1, so we can say it got extended by another 2 years. So the principal repayment is now going to be done 2 years later. Then he says the interest payments are reduced to 5% and the bonds are redeemable now at 15 lakhs on December Y1. So the interest rate stands reduced and the principal redemption instead of 10 lakhs is being changed to 15 lakhs. And then it says the legal and other fees is incurred. So that is my transaction cost. XYZ determined that the market interest rate on January X5 for the borrowings on similar terms is 11%. So this is the interest rate prevailing on the date when the renegotiations were done. That is the rate at which, the new rate prevailing on the date of renegotiations. But remember, in the 10% test, this has got no role to play. The calculations of the 10% test is purely based on the original EIR, which is 10%. Then he says the repayment schedule for the original debt till the date of renegotiation is given. So the principal balance outstanding is, of course, the same. We're just making a payment of the interest. That's it. So the interest is getting accrued and the same interest is being paid year by year. I think this chart practically not required because it is only showing you that every year the interest was accrued and we paid the same money. Then he says on January X5, the discounted present value of the remaining cash flows of the original financial liability is 10 lakh. Is this my step number one? When it says the present value of the remaining cash flows of the original financial liability, is this my step number one? That I've taken the present value of the remaining cash flows based on the original terms and you can say at the original discount rate, right? So that gives me my step number one. Then let's go further. Then he says on this data, now we are going to calculate the step number two as well. So let me do one thing. Let me just organize the calculations to you. So we are working on a 10% test. We are working on a 10% test. In terms of the step number one, you need to consider remaining cash flows based on the original terms discounted at the original rate. So you can remember it like this, remaining cash flows, and you can call it as ROO. I always tell people that, it's easy to remember ROO. So this is called the remaining cash flows. Let's put it like this. This is the remaining cash flows. And this is based on the original terms, what was agreed originally. And this is discounted at the original discount rate as well. So that would be easy to remember ROO. And that's how we can organize the data. Okay, so in this particular case now, we go to the step number one and the value as per step one is already given. Discounted present value of the remaining cash flows at the original liability is 10 lakh. And trust me, even if you want to compute the same, you're going to get 10 lakhs itself. Because if you consider that you're making a payment of only the interest every year, so remaining cash flows are what? The interest to be paid and the principal to be paid. So even if you discount them at 10%, undoubtedly it will come 10 lakhs. So that is my step number one. Now let's go to the step number two. In terms of the step number two, now you need to consider the modified, or you can say the new cash flows. So you need to consider the new cash flows, which is again based on the original discount rate itself. So we can say, you can call this as the new cash flows. So we can say the remaining cash flows based on the new terms at the original rate, RNO. So that is ROO and this is RNO, which is going to be the remaining cash flows based on the new terms, or you can say the modified terms. You can put it as, M as well, and the original discount rate. So R is for the remaining cash flow. N is based on the new terms. And we need to consider the O, which is again the original discount rate itself. Plus, you also need to remember to add any transaction cost as well. We need to also consider any transaction cost because this is sometimes people, forget to take. So you need to see what is the remaining cash flows on original terms, the remaining cash flows on the new terms, get the discounted values of both of them at the same discount rate. Now, in this particular case, we are required to make the interest payment at the rate of 5%. So now we're going to make a payment for how many years? 5 years have already passed by. So which means now the terms of tenure extended by another 2 years. Because originally it was X9, now it gets extended to Y1. So you're going to pay the interest for the next 7 years. Because out of the original terms of 10 years, 2 years have already passed by, 5 years have already passed by. So we can say 7 years interest. So on that 10 lakhs principal, 5% interest would mean 50,000. Discount this at a PVIFA, which is going to be at the rate of original rate 10% for a period of 7 years. So let's see what is the cumulative factor. 7%, 7 years, 10%. 1 divided by 1.1. 1, 2, 3, 4, 5, 6, 7. I think it's coming to 4.8684. 4.8684 up to 4 decimal places. And then there will be a repayment of 15 lakhs at the end of 7th year. So we need the fee factor at 10% 7th year. 1, 2, 3, 4, 5, 6, 7. That's 0.5132. That's 0.5132. This is the cumulative factor at the end of the 7th year. And plus, before we forget, there is a TC, and the TC incurred is 1 lakh rupee. So we need to consider the present value of all this. Let's see, what is the present value? So 4.8684 into 50,000, 243,420. 243,420. I think this is working out to, I guess, to the extent of 11,13,220, if I'm right. Yes, I think we're getting almost the same figure. So this is coming to 1113. So this is coming to 1113,158. I think I'm quite close, just a difference of around 40, 50 rupees. That's it. Fine. Okay, so once we get this data, this is the present value of the remaining cash flows at the new terms, discounted, of course, at the original rate. Now we take the variation. So we go to the step number 3. We go to the step number 3 and calculate the percentage variation in this case. So compare the difference between 2 and 1. So if I take the difference 11,13,220 minus 10 lakh, the variation is 1,13,220 over the base of 10 lakh. So let's see what is the percentage variation in this case. I think it's coming to 11.32% is the variation. Wow. So once you get the variation 11.32%, it's more than 10%. And if it is more than 10%, then in this particular case, extinguishment accounting would apply. So in this particular case, extinguishment accounting would be applicable because this is a percentage more than 10%. So this is the application of the 10% test. I hope, friends, you got this very clear, how the 10% test is going to be applied in order to decide whether it is extinguishment or a modification accounting. So far, so good, I guess. Okay. Now let's go forward and let's have a look further in terms of how the accounting is going to happen. So let's see further how the accounting in this case is going to happen. So there's more inputs which is given out here. So we're given more inputs out here in terms of how the accounting will be done. Now, I'm going to give you journal entries in this case to make it more clear. I'm going to give you journal entries in this case. Let me first read, but we'll give you journal entries. So let's, I think, have a look. It says the next step is to estimate the fair value of the modified liability. which is considering the present value of the cash flows using the interest rate 11%, which is the market rate at which the new bonds will be issued with the similar terms. Now remember, when you're going to do the journal entry for extinguishment accounting, you need to calculate the fair value of the liability, because we are going to put the entry something like this. If I were to see the entry which will apply in terms of extinguishment, so how the extinguishment accounting will be done? So the entry of extinguishment accounting is the old financial liability will get a debit at a book value. The old financial liability will be removed, derecognized from the books. Extinguishment accounting implies removal of the financial liability from the books of accounts, and this is at the book value. And creation of a new liability that will be given a credit, and this is going to be at a fair value. This is going to be at a fair value. So what is the fair value? Do not consider the data from the 10% test, because all that is based on original EIR. Now, when you consider the fair value, how do you consider the fair value? So you're going to take the present value of the new cash flows, which is based on the revised terms. So you can say it is supposed to be new cash flows based on the revised terms at the revised rate. So we need to consider the new cash flows. You can say the revised cash flows, the new cash flows at the revised terms, remainder period, of course, but at the revised rate. So in this particular case, we know that we are going to pay this 50,000 for the next 7 years, and we're going to pay this 15 lakhs at the end of 7th year. But discounting not at 10, discounting at 11%, the rate which is prevailing on the same kind of debentures with the same terms. So in this particular case, we'll calculate things at 11%. So when we go to consider the discounting, it's going to be at 11%. So let's see, 11%, 1 divided by 1.11. 1, 2, 3, 4, 5, 6, 7. The 7th year factor is 0.4817, and this is 4.7122 approximately. No TC. No TC. If it is a case of extinguishment accounting, do not consider any TC as a part of this new liability. The TC will be immediately expensed off. So no TC at this stage. So let me also caution that at this particular stage, you don't need to consider any transaction cost not to be included in the financial liability. So 2 areas of caution. I would say there are 2 areas of caution at this stage. The new financial liability is taken at a fair value, which is based on the discounting rate, which is the revised rate now. And secondly, no TC is to be taken. TC will be expensed off in this case. The standard does not allow you that advantage of TC being adjusted to financial liability. Reason, you renegotiated at a terms which is quite material. And if the renegotiated terms are material, I think I'm going to indirectly penalize you by telling you to put the entire TC in the P&L. So I think in this particular case, the standard setter's thought process was very clear. Because if it leads to extinguishment accounting, it is basically a material change, because it's more than a 10% change. And therefore, they did not allow the TC to be adjusted to FL. Originally, when you recognize a financial liability, the TC is always adjusted in terms of financial liability. But if it turns out to be extinguishment accounting, you do not get that advantage. That's another thing which we need to remember. So I think if you work this out, 0.4817, 722, 550. This is, I think, coming to 958, 160. So this comes to 958, 160. That is the fair value of this liability. And you can see the workings out here, the same workings are done. We're getting the answer 958,097. a slight difference, which is coming around 50-60 because of decimal places. Okay, now once this entry is done, the old financial liability is derecognized at a book value. The new financial liability is recognized at a fair value without the TC and considering a new effective interest rate. Any balancing figure in this entry is going to be adjusted in the profit and loss. So we're going to get a balancing figure on the credit side. That's a gain arising on a derecognition. That comes to 41,840. This is the gain, but let's also put the entry for the TC as well. So I think of the TC, we'll put the entry profit and loss gets a debit, the bank gets a credit, and this 1 lakh rupees of transaction cost also gets debited to the P&L. Now, if you see the net debit to the P&L, because in derecognition, there is gain, and TC, it's a loss. So if I see what is the net debit to the profit and loss, so we can take the sum of these two differences. It is 58,160. That is the net debit. And I think if I read it further, it says out here, a gain or loss on modification is taken. So we have given the loss is 58,097. So that is 58,097, which is after adjusting the TC as well. So I've given you the entries just for a more conceptual clarity, that once a 10% test is conducted and you lead to the conclusion that it is extinguishment accounting, the entry is removal of the old liability at a book value, recognition of the new liability at a fair value, and you need to remember fair value will be based on the new interest rate and no impact of TC. TC is to be immediately expensed off. So you get again a loss on derecognition, that's one, and you get the loss on account of TC, and you get the overall gain as well as a loss. I hope, friends, I stand absolutely clear on the concept of how extinguishment accounting is applied when the 10% test passes. So far, so good. I guess we're all clear with that. Okay, let's now proceed further. So we are now going to go to the next stage. So once we've discussed the concept of extinguishment accounting, now let's see the concept in terms of modification accounting. Okay, I said, everybody's clear. Nobody said a yes on that. Oh my God, this is getting technical in the morning. Anyway, I think today's session, you'll find it a little more technical as well, because all these special issues, what we are going to cover today is something, which is a little different in the sense it's all new to you. Because you've never been exposed to the concept of impairment testing or the concept of hedging. So all these things will be new to you, but we will spend some good examples to explain how things are done. I'll give you a very simplified version, but I know it's going to be a bit technical today. So anyway, the last phase of the financial instruments. Okay, so let's go to the next one now. That is modification accounting. Now there is something interesting to give you. Fortunately, unfortunately, Ind AS 109 is not very clear on the concept of modification accounting, and there are different industry practices which are applied in terms of modification accounting. And therefore, you're going to see two kinds of accountings which has been prescribed. One is pretty easy and straight. Let's see. It says Ind AS 109 is not clear as to the accounting treatment if the 10% test is failing. There are two alternative approaches available. So it says the first approach, the fees incurred is netted against the existing liability. The TC, in the given example, which is 1 lakh rupee, is reduced from the existing financial liability. Now let me ask you, if you're going to net this against the financial liability, will you be able to apply the original EIR, or do you think I need to change it? Because you've incurred a TC of 1 lakh rupee and that gets netted against the financial liability. So will I be able to continue with the original EIR, or will it trigger the need to calculate a new EIR? That's right. So let's have a look further. So I am given further inputs out here, and that's what it adds on. And that's what it adds on out here. It says the EIR is recalculated, And in this particular case, how would you recalculate this? We'll see. That's not a problem. In any case, so by the way, I think I'll let you know that EIR will definitely go up, because in this case, when you reduce the amount of financial liability, the cash outflow goes down. With the same inflows from the investor's point of view, the EIR will push up. And then it says now the adjusted EIR is used to determine the amortized cost and the interest for the future period. So in this case, the variation is not much. So therefore, the standard allows you to continue the financial liability in the books of accounts. So you can see there are two cases. One is a case of continue and one is a case of derecognition. So which means in terms of financial assets, there are three kinds of accounting. But in terms of financial liability, there are two kinds of accounting. There is no concept of a partial derecognition in terms of FL. It's either a complete derecognition or it is a case of continuation. Let's see further. It says on January X0, XYZ issues a 10-year bond for 10 lakhs, bearing a 10% interest. The bonds are redeemable on December X9 and there is no cost or fee incurred. So EIR is 10%. Everything is exactly what is given in the previous example, 100% same data. So then it says no further interest payments are made. The bonds are redeemed on the same maturity date for 16 lakhs. So unlike the previous case where the interest rate was reduced to 5%, here it says no further interest payments, only a principal payment of 16 lakhs at the end of original period, 5 years. And then there is a fees which is paid, that is TC. Here again, the original debt repayments are given, which really doesn't bother me much. Now, we are again required to do what? Conduct a 10% test. Every time you look at renegotiations of the financial liability, you need to first of all work on a 10% test, decide the kind of accounting, and in this case, we'll definitely go to come to a position where the variation is going to be below 10%, resulting in a modification accounting. How does that occur? Let's see. So let me, I think, work this out. So we're going to apply a 10% test. We're going to apply a 10% test. So the first one is we're going to take the present value of original cash flows discounted at the original discount rate. The same thing, it remains 10 lakh. So the present value of the original cash flows at the original rate is going to be 10 lakhs itself. Next, we need to consider the present value of the new cash flows, again discounted at the original discount rate, plus remember to take the TC as well. In the 10% test, you need to consider the TC as well. So in this particular case, we know that there are no interest payments in the future. So the only input is we're going to pay 16 lakhs at the end of another 5 years. So let's see at 10%, what is the discounting factor? 1 divided by 1.1, 1, 2, 3, 4, 5, 0.6209. So we take the present value of this 16 lakhs into 0.6209, that's 993,440, and there is a TC to the extent of 50,000. So this will give us the present value of the new cash flows at the original rate. So add another 50,000, that comes to 10,43,440. Then I think we can calculate the percentage variation comparing the two steps. So we get the percentage variation, the difference between the two upon the original. So difference is supposed to be 43,440. So this is, I think, coming to 4.34% is the variation. So that's below 10%. And if it is below 10%, this means that we're applying a modification accounting. The change is not material in nature. So this is going to result in what we call a modification accounting. So this is only to decide that what kind of accounting would be applicable. And then we need to see how would you do the accounting. I'll give you journal entries again. In this particular case, there is going to be one simple entry only. So what we're going to do, that we incurred a TC of 50,000. So you will put the entry financial liability gets a debit and the bank gets a credit. So this 50,000 TC is going to be reduced from the financial liability. So the only accounting to be done in this case is the reduction of the TC out of the financial liability. And this will now involve, this means that there is a need to recompute. There is a need to recompute the effective interest rate for future interest calculations. Because once you reduce the amount of TC from the financial liability, now you cannot use the original EIR of 10%. There is a need to recompute the EIR. How would you recompute the EIR? Consider things from the investor's point of view. Let's say the outflow is 950 and there is only one inflow, 16 lakhs at the end of 5 years. See where the present value of 16 lakhs equals 950. So if you want to recalculate the effective interest rate, we can say the cash outflow at time 0 is supposed to be 9.5 lakhs. And the only cash inflow is at the end of 5th year, that is 16 lakh. So calculate the discount rate. Calculate the discount rate at which the present value of 16 lakhs will equal 9 lakh 50 at 0 point of time. So this calculation is not done, but this is just shown out here. So I'll just, show you the inputs out here. So let me just crop this bit. So let me just crop this out here to show you the further workings. So in this particular case, there is now a need to recompute the effective interest rate. So it says the EIR is recalculated. So where the present value of 16 lakhs in 5 years is equal to 9 lakh 50, that comes to 10.99%. So this is given to me, it's 10.99%. So that is the new effective interest rate. So you need to see when the present value of 16 lakhs will equal 9 lakh 50 at 0 point of time. So approximately 11%, that comes to 10.99%. So when you calculate this, this is going to come to 10.99% is the effective interest rate. Wow. So this gives us one alternative accounting treatment. I think let me just summarize the inputs to you. Because once you've conducted a 10% test, it leads to only 2 kinds of accounting for a financial liability, unlike the 3 kinds of accounting for a financial asset. So I think let me just pen this down. Okay, so I think let's do one thing. Let's make a summary chart, a small little mind map at this stage. So on the financial liabilities, let me make a quick summary chart to summarize the provisions on the derecognition of financial liabilities at this stage. So I'm just telling you now that in terms of derecognition of financial liabilities, what do you need to do? In terms of derecognition of financial liabilities, you are required to conduct a 10% test. You're required to conduct a 10% test, which I've already given you, is based on a 3-step model. I'm not summarizing that inputs now. The 3-step model already given to you. And in step 1, you take the original cash flows, original discount rate. In step 2, new cash flows, original rate plus TC, get the variation. So once you get the percentage variation, once you apply the percentage variation, I would say there are 2 kinds of accounting which comes. So if you say the variation is 10% or more, or if you say the variation is, let's say, less than 10%. So the variation is 10% or more, or if you say the variation is less than 10%. So what we need to consider first of all, that if it is 10% or more, if it is 10% or more, we need to apply extinguishment accounting. In this case, we need to apply what is called the extinguishment accounting. And when you say it is less than 10%, it is supposed to be modification accounting. And just to quickly add on what is to be done in terms of extinguishment or in terms of modification accounting. So if it is supposed to be extinguishment accounting, you need to put the entry old financial liability gets a debit at a book value. The new financial liability gets a credit at a fair value. And this fair value is based on the discount rate, which is the new effective interest rate. That is one thing which you need to remember. And the second thing which you need to remember, that do not take any TC at this stage. So any balancing figure in this case will be a gain or loss arising on a derecognition, which will enter the P&L. And along with this, the TC will also be charged to the P&L. So another entry will be done. The profit and loss gets a debit, the bank gets a credit for the TC. So two entries to be done. If it is a case of a modification accounting, then in that particular case, we just need to do one alternative treatment given in the study mat, which is reduce the TC from financial liability and recompute the new effective interest rate for future interest calculations. That's it. As simple as that. So I think that summarizes the input in terms of once you apply a 10% test and you get the results that the variation is 10% or more, extinguishment accounting, and if it is less than 10%, modification accounting. So what is the first alternative which is there? I'm not giving the second alternative because this is the only alternative treatment which is given, that you reduce the TC from the financial liability, recompute the EIR. So depending upon the percentage variations, two different accounting treatments are given. So now you can get the comparative things in your mind. Financial assets, there are three kinds of accounting. Financial liabilities, there are two kinds of accounting. Financial assets, you've got a full derecognition, you've got a partial derecognitions, and you've got the concept of no derecognition. In financial liabilities, only two accounting treatments, full derecognition or no derecognition continuation. There's no partial derecognitions in terms of financial liability. Right, friends, so far so good. I hope we stand clear at this stage. All good, I guess. So now we need to go to the other special issues with you. As I said, that there are total 4 special issues in the standard on 109. Derecognition of financial asset liability done. Now we've got 3 areas. Impairment, there is 1. Hedging, there is 2. And the concept of embedded derivatives, there is 3. So I'm going to start my journey with impairment, then I'll go to the concept of hedging, and then I'll come to the concept of embedded derivatives as well. So far so good. I hope you're all clear so far. Now this is going to get a little more technical indeed. So far so good. I guess clear to the stage. Wonderful indeed. Okay, now I am going to take it further. And we are going to discuss impairment. I'm going to go slow on that because this is one area where, a lot of information is to be given. So I'm just going to give you a very simple input and explain this with an example later. First, we need to understand the concept. So let me, I guess, first of all, take you on the inputs out here. Let me introduce you to the concept of impairment to begin with. So let's have a look, first of all, on the concept of impairment. So we're looking at the impairment discussions in Index 109. Now, please hear this carefully. We'll go slow because there are some new things coming to your mind. What we are about to do is very complicated in a practical world situation, but of course, from the examination point of view, you may not feel that kind of intensity. But of course, since you're maybe learning for the first time, this could be a little more tricky issue to understand. Now, in order to ease the understanding of impairment, what I have done, I've converted this again into a step-by-step approach. And there goes again a 3-step model with which I will expose you to the concept of impairment. And first, let's give you the outline regarding the 3-step model which we are going to follow. Now you must be thinking so many three-step models given in the standard, Index 32, Index 109, within them three-step models. Yes, there will be an easy way to understand and approach and apply the standard. Now, step number one. The first step is to understand that are we within the scope of the standard or not. Now, let me remind you one thing. There are two standards which deals with the concept of impairment. One is Index 36 and one is Index 109. Index 36 per se deals with non-financial assets because there are two kinds of assets in the balance sheet of the company. So one is assets which are non-financial and one is assets which are financial. So when you look at Index 36, it tackles the impairment for non-financial assets per se, because there are exceptions, but we'll not get into all that. And when it comes to the impairment of financial assets, then Index 109 is applicable. So first you need to see that the asset in question is financial or non-financial in nature. If it is non-financial, per se, it is covered under 36. If it is financial asset, then it is covered under 109. So let me put it like this. So when you look at the scope of the standard, we can say per se, if you're looking at non-financial assets, then they are covered under Ind AS 36. And when you're looking at financial assets, then we're looking at Index 109. So first you need to zero down that the financial asset in question is there, because 109 will apply typically to a financial asset. Now, you already know this, that financial assets can be debt investments or financial assets can be equity investments, because the accounting of financial assets is divided in terms of two categories. So I think if we go with the chain further, so we can say in terms of Index 109, either it is a case of a debt investments or it is a case of equity investments. And further, when you look at those debt equity investments, in terms of debt investments, there are three categories. And in terms of the equity investments, there are two categories. So I had already given you this aspect in the chart earlier. When we did the subsequent measurement of financial assets, I had clearly given you at that stage, and I told you, I'll remind you what I'd given you in the chart. So today, let me just, reconnect the dots. So debt investments could be taken at AC or FPT OCI, which is R, or FPTPL. Equity investments could be FPT OCI NR, or they can be taken at FPTPL. So I think in the scope of the standard, the first thing you need to see is that is it supposed to be a financial asset? And then you zero down that it's a debt investment or it is an equity investment. So let's make one thing point blank clear. If you're looking at equity investments, whether OCI, FPTPL, we can say impairment is not applicable. Equity investments are not tested for impairment. They're not tested for impairment under 109, whether it is FPTPL or FPT OCI, no. And I think I gave you the reason there also. I said for equity investments, OCI, the standard setters were very, very keen on the part that we don't want to touch the P&L. Mind the words, what I'm saying right now. The standard setters were very clear that in terms of equity investments, FPT, OCI, they don't want to touch. They don't want to touch the P&L. So remember, any fair value changes unrealized went to the OCI. Realized gains or losses went to the OCI. And now even the impairment is not applicable. So effectively nothing can enter the P&L except for any dividends which you get on these equity investments. Practically nothing will enter the profit and loss of the company, because you are saying the unrealized gain loss goes in OCI, the realized gain loss goes in OCI, And in terms of impairment also, I don't want to conduct impairment because impairment losses goes in the P&L. And the standard setters did not want anything pertaining to the equity investments entering the P&L. So they said, no, we're not conducting impairment testing. But when it came to debt investments, they decided that these are the two categories where impairment testing would be applicable. As far as FPTPL is concerned, not applicable. So which means FPTPL, the accounting for debt equity is common, no impairment testing. But in terms of equity investments, OCI, there is no impairment. But in terms of debt investment, there is impairment. Because in terms of debt investments, the unrealized gain loss goes in OCI. The realized gain loss goes in the P&L. And if there is an impairment, if there is a loss in terms of value, that is also unrealized loss and it should hit the P&L. So they decided a different accounting for equity, no impairment, and a different accounting for debt, that means conducting impairment. So the first thing what you're going to see in a question is, look at the fact that, okay, is it a financial asset, debt investments? So I can say one thing in short. Let me put it like this. Can I say all the financial assets which are debt investments measured at AC and OCI are covered under Ind AS 109 impairment? Is that correct to say? So I think if somebody wants to, give me a one sentence in terms of the scope, so I would say all financial assets which are debt investments measured at AC or FPT OCI are under the purview of impairment testing. That's it. And that's rightly agreed. Okay. So this is the step number one, that is the scope of the standard. Then we come to the step number two to decide the approach. Now, let me tell you one thing. When it comes to the approach, I did not explain what is impairment because I believe you know what is impairment. So impairment is basically, you can say, the expectations that money may not be received. You've got a financial asset which gives you a contractual right to receive, but then there are certain expectations that you may not get the money. The other party might default and you may not get the money. So in terms of impairment, we're looking at the risk, and that is called technically a credit risk. That is called technically a credit risk. That, if there is a default by the other party and he does not pay the money, every time I'm running a credit risk. So in this particular case, the approach, the standard setters initially decided that there are two kinds of approaches. One is called incurred loss model. So they decided that there are two kinds of model which can be applied. One is called the incurred loss model and one is called the expected loss. So one is that you consider the incurred loss and one is you consider the expected loss. Now, the standard setters very clearly decided we are not going for an incurred loss model. So they decided that incurred loss model is out of the picture. They decided to use the expected loss model, and that's why it is called ECL. That's called expected credit loss. Do not consider a provision for a loss. Do not consider a provision for the impairment on the basis of the loss which has already occurred. But consider what is the expectations. Based on the circumstances, you need to do a forecasting. You need to look into a forward looking and see how much money is not expected to be collected. You know the agreed contractual dates when you're going to get the money, but you need to sit down and see that, okay, am I expecting that I will not get money at the designated dates? So look at the expectations and create a provision. So therefore, they decided we're using an expected loss that's called an expected credit loss. Now, in terms of the expected credit loss, they decided to introduce two approaches. In terms of the expected credit loss. Now, what are the two approaches? The approach number one is called journal approach. The approach number one is called a journal approach, And the approach number 2 is called a simplified approach. So I'll first explain to you what is this general approach and what is the simplified approach. Now, we need to choose, depending upon the category of financial asset, that do we apply a simplified approach or do we apply a general approach? So we'll come to that part later, that which financial asset is covered under which approach. But first, let's give you the general approach. Let's first understand the general approach. What is the general approach? Now, let's take a timeline to understand the concept of a general approach. Let's say my company is given a loan to someone. So if my company gives a loan to someone, it definitely creates a financial asset, because the loan which I have given, it creates a contractual right to receive. So it is a financial asset to me. So let's say this is the time zero when I gave a loan to someone. Now, what is the standard requiring me to do? Please hear this carefully. The standard says the day you gave a loan, that is on the date of initial recognition, do what is called a credit risk assessment. So they say on time zero, what you need to do is do a credit risk assessment. So what I'm required to do is do a credit risk assessment. Now, what is a credit risk assessment? As I said earlier, the default can occur. Because every time you got a financial asset, you're running the risk, the sword is hanging on your head, and which is telling you that maybe the other person does not pay you. Simply because you've got a contractual right to receive does not mean that you're safe. Because you've got a contractual right to receive, but the other person is not having enough ability to pay. So you're running the risk of not getting the money back. So in this case, the standard setters required the companies to do what is called a credit risk assessment. Through the credit risk assessment, now mind the words, through the credit risk assessment, they wanted that the company should be able to visualize what is the probability of default. So they said that if you're able to visualize the credit risk assessment, you are able to understand what is the possibility of a default occurring. We want you to, after doing the credit risk assessment, zero down on what is the probability of default. Do you expect that there is a 10% probability, or do you expect the probability is just 0.5%? It doesn't make a difference. It doesn't make a difference. It's not that you're going to make a provision only if there is a probability of more than 50. Please don't keep that confusion in mind. The standard setters were very clear on the objective. You're not going to create a provision only when the probability of default is more than 50. No, I will create a provision even if my expectation is that there is a 1% chance the other person may not pay. So we need to basically, with a credit risk assessment, calculate a probability of default. Now, what we're going to do? Let's say at the end of first year, that is T1. I'm putting as T1. So what I'm going to do again at T1, I will repeat the credit risk assessment. At the end of the first year, we will repeat the credit risk assessment. That means the credit risk assessment is done at T0 and the credit risk assessment is again done at the end of first year. And trust me, this exercise will be done at every balance sheet date. At the end of second year, at the end of third year, I will sit down and do a credit risk assessment at each balance sheet date. Now, once you've done the credit risk assessment, you need to basically compare the results. You need to basically compare the results that you've conducted a credit risk assessment, and let's compare the results. That what was the credit risk at the inception and what is the credit risk at the end. You need to compare the credit risk is increasing or not. So what these standards said was something interesting. By making a comparison, you need to basically assess. That is there a significant increase? Is there a significant increase in credit risk? Your comparison of the two credit risks will basically give you an assessment of the fact that is there a significant increase in the credit risk. So I call it as SICR. I call this as SICR. That is called a significant increase in the credit risk. So the company made a credit risk assessment at the inception T0. At the end of first year, you again made a credit risk assessment and you saw that, okay, is there a significant increase in the credit risk or not? Now, I'm taking two permutation combination. So let's say there are two combinations coming in. So I say, no, there is no significant increase, or I say, yes, there is a significant increase. So once I sit down and I say, no, there is no significant increase, I think the credit risk is not significantly increased, or the credit risk is significantly increased, which means the possibility of a default occurring either has gone up substantially, significantly, or the credit risk, that is the possibility to default, has not gone up significantly. Now, if you say no, it is not gone significantly, we are supposed to apply what is called a 12 months ECL. And if you say yes, we are supposed to apply what is called a lifetime ECL. Now you would say, what is this? You would say, what is this? That you're applying a lifetime or you're applying a 12 months ECL. I'll tell you now. So, for example, if you conducted the significant increase credit risk assessment test and you said, no, it's not significantly gone up, I don't need to do too much forecasting. I will basically visualize that in any case, I'm going to make a balance sheet after the next 12 months. Get this point clear? Where does this 12 months come from? Every year, you're going to make a balance sheet in any case. So I think if the credit risk is not significantly increased, let me only forecast the conditions which will prevail over the next 12 months. Let me look at the forecasting only for 12 months, just 1 year. Let me visualize the expectations in the next 1 year and consider if those kind of conditions are going to prevail, then what is the possibility, what is the probability of default? But if you say that the credit risk is increased significantly, I will say no, now I will not restrain myself. I will not restrain myself to look at the conditions over the next 12 months, but I'll look at the lifetime. Lifetime means, let's say the tenure of this loan is 10 years. Let's say the tenure of this loan is 10 years. Sitting at the end of first year, I'll visualize the conditions which will prevail over the next 9 years. I will look at the conditions which will prevail over the next 9 years and then make an assessment regarding the probability of default. So the standard setters wanted the company that on the credit risk assessment, if you say the credit risk is not increased significantly, you can do and look at the conditions over the next 1 year only. Because you're going to make a balance sheet every year. So there is no need of doing so much of a forecasting. You can only look at the conditions which will prevail over the next 1 year. But if the increase in the credit risk is significant in nature, we will not restrict our forecasting. We will not restrict our forecasting to the conditions over the next 12 months, but we will look at the conditions which will prevail over the entire lifetime of that financial asset. So in my example, I'm going to look at the credit risk, the expectations over the next 9 years. And once I'm able to forecast, looking at the conditions which will prevail over the next 9 years, through this, whether it is a 12 months ECL or it is a lifetime ECL, with the help of this, what we will do, we will be able to calculate what is called a POD. That's called a probability of default. So we will be able to zero down and calculate what is called POD, a probability of default. So the companies with an approach that is a journal approach, they will be able to visualize that, okay, do we need to look into the conditions over the next 12 months? Do we need to look at the conditions over the lifetime of the instrument and through which we will get the POD? Now, trust me, in a practical life scenario, getting a POD can be the biggest problems in life. That's not an easy task. We'll not get into the concept of calculating a POD because from the practical point of view, it has got a huge number of challenges. But this percentage is always given in the question. The examiner cannot ask you to do a credit risk assessment. They will tell you the results that the credit risk is significantly increased or decreased. They will give you based on the assessment test done that what is the default probability. So step 2 is going to be pretty easy, but you need to know the insights. You need to understand that what kind of approach is applied, and conceptually you need to be clear that once the journal approach is applied and you make the assessment of the significant increase or not, looking at the conditions which will prevail over the next 1 year or the conditions which will prevail over the lifetime of the instrument, you are able to achieve what is called the probability of default. So we will get a percentage. And when you do all this exercise, let me tell you, conceptually, when you do all this exercise, you are doing two things. When you're looking at the probability of default, you're technically doing two things. One is called backward looking. One is called backward looking, and one is called a forward looking. So it involves looking at the backward and the forward trends both. We need to see the historical defaults, because when you look at the backward looking, when you look at backward, you will be able to get the historical defaults. You will be able to get the historical rates of default. And when you're looking at the forward looking, then you will be able to update. Then you will be able to update this historical rate as well. So this involves looking at a lot of factors. So you will look into, what is the experience been? Based on my historical experiences, what is the default probabilities which have occurred? And based on the economic conditions which will prevail regarding my industry, the business in which I operate, looking at the macro conditions, then I will be able to update this historical rate. That is this historical rate going to go up, or is this historical rate going to go down? So all those assessments will be done, and you will be able to fine tune what is called the probability of default. Did you get the insight so far, friends? I know it's technical. I know indeed it's technical, but I hope you're able to catch up with the points in this case. Okay, I get a question. So since the POD contains a lot of difficulties, then why industries go for a simplified approach? No, considering a simplified approach is not a matter of choice. I already said that, there are two approaches. I said we'll come back to the issue of deciding which approach is applied in which case. But it's not a matter of choice for the company that they can use a simplified approach. The journal approach is an approach which applies by default. The journal approach is the approach which applies by default. So let me, answer that question right away. When you're looking at the concept of a simplified approach, this approach is typically applicable to trade receivables which has no significant financing component as per Ind AS 115. The revenue standard tells you to identify whether your trade receivable contains a significant interest element. So there are other cases, but I think you can say the only practical case, effectively, the only case where a simplified approach can be applied is the trade receivable which has got no significant financing component. Why it is called a simplified approach? Because in terms of simplified approach, we only apply the concept of lifetime ECL. The simplified approach makes the life simple. It says there is no need to do any credit risk assessment. So the simplified approach is going to apply only in terms of trade receivable, which is got no significant financing component. And that means what? If the trade receivable has got no significant financing component, it seems to be less than a year. If it seems to be less than a year, then in that particular case, if you apply a lifetime ECL, that's always, more or less going to be a case of less than 1 year. Because a trade receivable which is less than a 1 year credit period, that does not contain any significant interest element. So therefore, they said that this is the only approach you're going to apply to the trade receivable. So the journal approach in this case is something which is applied by default. Every company to all the financial assets will apply the journal approach. So let me just connect the dots. So when it comes to the approach, you can say If I've got a trade receivables with a, you can say, no significant financing component, you can use a simplified approach. If you use a simplified approach, then in that case, credit risk assessment is not required because you need to apply a lifetime ECL only. But by default, all other financial assets are going to be considered using a general approach where a credit risk assessment will require to be done. And you need to see that if there is any significant increase in the credit risk. If you say no, there is no significant increase, then you can apply a 12 months ECL forecasting the conditions over the next 1 year only. But if you say that there is a significant increase in terms of credit risk, then you need to apply a lifetime ECL considering the risk which will prevail over the entire tenure of the financial asset. And based on this assessment's 12 months lifetime, you're going to zero down on what is called the POD, the probability of default, which is going to involve historical experiences, looking at the backward trend, and doing a forecasting, looking at the conditions which will prevail. So by a forward-looking and a backward-looking, the companies will be able to get a POD that's called a probability of default. That what is the percentage probability that, okay, the person is not going to pay me money. Right, I guess you got your answer on that regarding the approach which you said. So selection criteria by default is general approach. Okay, that's great. And I think I got the answer yes on that. So far, so good. So the step number 2 is done. The step 1 is to zero down whether you're within the scope of the standard. The step number 2 is to look at the approach. And finally, you can say the step number 2 will give you the POD. Then comes the step number 3. So this was step 2. This was the step number 2, that is the approach. Now let's go to the step number 3. So once you've got the probability of default, then comes the step number 3, and this is creating a provision. This is creating a provision for what we say ECL, expected credit loss. It's like, creating a provision for doubtful debts, but here we call it as an expected credit loss. That what is the expectations? What is the expectations that you will not receive the money? So we need to basically make a visualization of that. That what is the expectations that you're not going to get the money? So provision for ECL is going to be based on 3 factors. Now watch this carefully. We're going to multiply EAD into LGD into the POD into the time value of money if relevant. So there are 4 factors. You can say there are 4 factors which will decide the calculation of the impairment loss. So there are going to be a total of 4 factors which will decide the impairment loss. One is the exposure at default. So let me write down these terms as well. So EAD is basically what is called exposure at default. Well, I think you may technically call it as exposure at default, but at the end of the day, it is basically, you can say, the value of financial asset. Whatever is the value of the financial asset, that can be called as a EAD. What is the amount which is exposed to a default? So when you say EAD, you need to look at the amount which is exposed to a default. So that is called the exposure at default. Looking at the amount, the value of the financial asset. LGD is what is called loss given default. LGD is called loss given default. I'll explain that with a small example. What is LGD? POD you already know is called the probability of default, which you will be able to zero down in terms of the step number 2. You'll be able to zero down this on the basis of step number 2, that what is the default probability and time value of money if it is relevant. When it is relevant, we'll see. I think let's take a small example to understand the application of the 3rd step. Then I'll take you to a larger question, understanding how this 3-step model is going to be applied. Now, let's take a very simple example, first of all, to illustrate the inputs in terms of how these parameters would apply. Let's say, for example, I have a financial asset, let's say to the extent of 20 lakhs. Let's say the financial asset is worth 20 lakhs, and let's say there is a security. Let's say there is a security available, and the realizable value of this security is, let's say, to the extent of 15 lakhs. Now, let me ask you a very simple question. The financial asset is for 20 lakhs and the security against that loan is realizable value is 15. In a worst to worst scenario, what is the recovery rate in a percentage term? If I were to calculate what is the recovery rate, what is the recovery rate in this case? Can I say out of 20 lakhs, what is the percentage you will recover in a worst to worst scenario? So would you like to calculate the percentage and give me? And that's right, it comes to 75%. So we can say if I were to calculate RR, that is called the recovery rate. If I were to calculate RR, that is my recovery rate. So I would say the recovery rate is 75%. So LGD, loss given default, is the remaining 25%. So 1 minus the recovery rate is supposed to be LGD, the loss given default, that in a worst to worst scenario, you will not be able to recover 25% of the money. So in this particular case, if I look at the exposure at default, it is 20 lakh. What is my LGD is 25%. So this is the maximum loss which can occur. This is the maximum loss which can occur because 25% of this money may not be recovered, but I'm not going to create a provision of 5 lakh. I need to see what is the probability that this money is not collected. So let's say based on the step number 2, you calculated that there is a 5% probability of not getting this money. There is a 95% chance of getting this money. So I will create a provision. Let's forget the time value money is not relevant. So 20 lakhs into 25% into 5%. So this is the amount of provision which is going to be created. So it's as simple as that. So which means the main exercise is in terms of getting that POD. The main input is getting the POD, because once you're able to get the POD, this is the value of the asset. This is the maximum default which can occur, but we will consider the default probability as well. Now, let's say if this money is supposed to be collected over the next more than 1 year, I would also discount it to time value money and calculate that, okay, this is the amount which I'm not expected to receive. So discount that money over time value of money as well. So this is the input in terms of 3-step model applicable to the concept of impairment. Right, friends? So I think let's go further. Now let's, I think, apply this to a practical illustration with you. I think it's not very technical. Yes, it is, but not very technical indeed, especially when it comes from the examination point of view, where the default probabilities, everything will be fairly given to you. So I think that does not create any problem. Okay, let's, I think, do this question. I am carrying a small little question from my side to give you the inputs in terms of how this 3-step model is to be applied. So let me just read the inputs to you, and we're going to apply the 3-step model in terms of this particular example. Let's read. So we are given, discuss the accounting treatment of the financial asset on December X1. Now, as we read, we will continuously apply the 3-step model. The first one is the scope. The second one is the approach and deciding a POD, whether it's a simplified or a general approach. And the third step is creating a provision in the books of accounts. It says on 1st January X1, NAPA purchased a bond for 1 million, which is measured at AC. The moment I say that it is an investment in a bond measured at AC, it's a debt investments at AC, so it is within the scope of the standard. Step 1. Then he says interest of 10% is payable in arrears and the repayment is on December X3. The effective interest rate is 10%. Then he says on December X1, NAPA received the interest. It estimated that the probability of default, that is the step number 2, within the next 12 months is 0.5%. Now, when he calculated the probability of default, that means he has applied the concept of a journal approach because it's not a case of trade receivable. So he's already applied the concept of a journal approach and given you the POD based on a 12 months ACL, that's 0.5. If the default occurs within the next 12 months, NABA estimates no further interest will be received and only 50% of the capital will be repaid on December X3, considering the conditions prevailing over the next 12 months. Considering the conditions prevailing over the next 12 months, having the historical experience and looking at a forward looking, he's reached a conclusion that no interest will be collected and only 50% principal money will come in. It says the asset credit risk is supposed to be low. So when the credit risk is low, it indicates we need to apply a 12 months ACL in any case. I think you would have well understood the inputs in terms of the question. I think if the language of the question is clear, you've understood the broader input in terms of impairment. Now let's apply the three-step model in this case and get the results. So I think let's do it on the next one. So I am going to work on the three-step model. So this is my answer to the question number 9. So we're going to apply the 3 steps in this case. The step number 1, the step number 2, and the step number 3. I'm not making a very deep insight in terms of the impairment because questions which are there in impairment are very simple. You look at questions in the study material also where we're directly given the percentages of POD, multiply, get the results, and that and simple and straight. So this is one area which is not, tested on a very heavy manner in the exams. So I thought, let's give you something different and you can practice those questions from the study. So first is that we're looking at, is it in the scope of the standard? Yes. Very much in the scope of the standard. Reason? It is supposed to be a debt investment measured at AC. Since it is a debt investment measured at amortized cost, very much within the scope of the standard. Then we go to the second one and we decide the approach. It is not a case of a trade receivable, so we apply the journal approach. And when you measured the significant increase in credit risk, it said it is low. That leads to the conclusion that we are applying a 12 months ACL. And it gives you a probability of default that is 0.5%. That is also stated in the question. So by applying the journal approach, and evaluating the significant increase in credit risk already given in the question, it's low and the default is given. So we now need to create a provision. And the provision in this case is supposed to be exposure at default into the loss given default and into the probability of default and into the time value of money as well. Okay, now comes the picture. Let me, I think, put some small little question to you at this stage. Can I say that when you multiply the EAD into LGD, is this the amount which you will not recover? Does this represent the amount which will not be received? Is that correct to say the amount which will not be received? Because when you're multiplying the LGD into EAD, you're going to get the money which you're not going to recover. And let me also consider time value of money as well. The money which you're not going to receive in the future, discounted to time value money, that is the amount which I will not get. Correct? So I think if I go back to the question and look at the details, it says out here that if a default occurs over the next 12 months, NABA estimates no further interest will be collected. So you're not going to get the interest for the next 2 years. And only 50% principal will be repaid. So which means you will not get the interest. So which means you will not get the interest for the next 2 years and you will not get 50% principal. And since this is involving 2 years, time value money becomes relevant in this case. So what we're going to do in this case, calculate. So we can calculate the interest which we are not going to get. So what is the interest rate? 10% on 10 lakhs. So we will not receive the interest for the next 2 years. We will not receive 50% of the principal at the end of another 2 years. So there are two things. You're not going to get the interest for the next 2 years to come, and you're not going to get the principal 50% over the next year. And let's take the discounting at the rate of 10%. So this is going to be 0.826, and this is going to be 1.736. So using the 10% interest rate into account, so this is the interest for the next 2 years which you will not receive. This is 50% of the principal which you will not receive. So let me now put the question to you. Is this the sum total? Is this the product of these three factors? Yes or no? When you multiply the EAD into LGD into time value money, can I say this represents what is the amount you will not receive in accordance with the time value of money, right? That's correct. And then the probability of default is 0.5%, and this will give us what is the provision to be created. As simple as that. So this is going to be 5 lakhs into 0.826, 4 lakh 13. So this comes to 0.005. So this is, I think, coming to 2933. This is the provision to be created for the expected credit loss. Wow. So this gives us the concept of an impairment with a three-step model, understanding that whether you're in the scope of the standard, there is one. Then you need to see that, okay, in this particular case, what is the POD, depending upon the credit risk is significantly increased or not. And then you go to the step number 3, create a provisions based on 4 parameters, the exposure at default, the loss given default, the probability of default, and the time value of money if it is relevant. Right, friends, I hope you got a basic inputs clear on the concept of impairment. Not very tough indeed. Conceptually clear with the concept of impairments. There are a lot of the things which can be given, but I'm not getting into those technicalities considering the examination perspective, keeping it simple and straight. Right, so far so good. I hope you've understood the concept. Now let's go on to the next issue in terms of the special issue on the standard. Great. So my next special issue of discussion is going to be on the next issue. So there were 4 issues. We have done 2 issues. Derecognition is done. Impairment is done. Now we are coming to the concept of what is called hedging. Now this is interesting and can get technical as well. I'm going to spend some time on the concept of hedging, because I think this is one thing, people love to, understand as well. To my mind, I think I don't remember if there has been much examination questions on this area, but there was one question, of course, which came in the RTPs, which was a very interesting question. So we'll make a little, better walkthrough in terms of understanding hedging. Now, first of all, we need to understand what is hedging. Hedging basically means to protect. Hedging basically means, in simple English language, it means to protect. I always tell people that, if you're looking at the concept of hedging, let's take a very simple example to understand what hedging is. So I say, that let's assume that it's raining outside. Now, what are you going to do when it's raining outside? Undoubtedly, you'll take an umbrella. So when you take an umbrella, are you assured that there will not be a single drop of water, single drop of rainwater coming to you? Of course not. Even if you take an umbrella, that does not assure you, that does not mean that you will not get drenched. So you're trying to protect yourself, but there can never be 100% protection. So hedging is also something which can protect the company, but they may not be protected 100%. They can. I don't deny the fact that there could be a theoretical possibility of getting, a covered protection against a loss, or, keeping a gain intact. Let me also tell you that when you look at hedging, it could be, with the intention of keeping a gain intact, or it could be with the intention of protecting against a loss. The companies might be able to achieve 100% protection, but then it's more theoretical. And you can say that, we may be able to protect ourselves maybe around a 95% or so, or maybe between 90 to 95%, we may be able to protect ourselves. So the question arises that in a business situations, what kind of, protection are we wanting? We face a lot of risk in a business. Like, for example, let's take a very simple example of a company like ITC Limited, which is required, cocoa beans to produce coffee. So when they're required to, they're required to consume cocoa beans to manufacture coffee. So they will enter into some kind of derivative contracts where they will enter into commodity derivatives to buy this, cocoa beans at a pre-decided rate at a future date. So because they're running a risk, so they would like to enter into contracts to protect against the rising prices. So many industries would face a risk in terms of, there might be more cash outflows which will occur because of changes in exchange rates, for example. Or there may be less inflows coming into me because of exchange rate getting adverse. So as an importer, as an exporter, I'm exposed to exchange rates due to which my inflows, my outflows can drastically go up and go down. I might be simply planning to buy a machine at a future date, let's say in a foreign currency. So I'm exposed to the currency risk factor. So businesses are exposed to various kinds of risk and they need to contain that risk, and that's a choice. You cannot tell a company that you're facing a risk and you should, take some kind of precautionary measures. Taking a preventive measures, taking a precautionary measures is a complete choice for the company. So the company is facing a risk, they want to protect themselves against the risk is completely a choice of the company. And therefore, the standard setters decided that hedging is completely an optional tool in the hands of the company. You want to protect yourself against the expected risk or not is a matter of choice. So they said you can protect yourself, you may not protect yourself. So basically, I just gave you that risk is what different businesses will face, and the companies need to consciously decide, I want to protect against the risk or not. And if they decide to protect against risk, then they can get a wonderful tool, which is called hedging. Now, since the hedging again is a little technical agenda, so what I've done, I could not contain this in terms of 3-step. So what I've done for the ease of understanding, divided this into a 5-step model. The Index 115 has got a 5-step model, so I got fascinated with the 5-step model. So somewhere I've created 3 steps, somewhere I've created 5 steps. But trust me, creating steps doesn't mean that we're converting a principle-based accounting into rule-based accounting. The steps will only tell you how to proceed, but the subjectivity of the principles contained in the standard would of course remain. So what I've done in this case, I've divided the entire hedging into a 5-step model. So we've converted this entire hedging process in terms of a 5-step model. So let me first of all give you an exposure in terms of how this 5-step model is going to work. Step number 1, step number 2, step number 3, step number 4, and step 5. So let me first outline those 5 steps to you, and then we can start working on the accounting as far as hedging is concerned. The step 1 is called identifying what is called the hedged item. And the step number 2 is getting what is called hedging instrument. What is called hedging instrument. So there are 2 things. One is called hedged item and the second one is called hedging instrument. Now let's understand what is a hedged item and what is a hedging instrument. Coming back to the same example which I gave you, let's say it's raining outside. So what I will do, I'll take an umbrella. So what is that umbrella? The umbrella is protecting me. So the umbrella which is protecting me is what I can technically call hedging instrument. And what am I trying to protect? I'm trying to protect myself. So what am I? I'm supposed to be the hedged item. So the company needs to first of all zero down what they want to protect. So what is the item which can be asset, which can be liability? It can be recognized, it can be unrecognized in the balance sheet as of date. When you're planning a hedging, it is not necessary that the asset and liability is already in the balance sheet of the company. The company can choose to protect any asset liability, whether it is already in the balance sheet today or whether it's not in the balance sheet. So we'll come to that detail, but we can say hedged item. If somebody were to tell me what is a hedged item, we can say the asset or liability which we want to protect. It is the asset or liability which we want to protect. I think let's give you a little more insights on that because our focus will be more on the accounting. So let's give you some more insights on the hedged item. Now, as I said, that this asset and liability may be recognized or it may be unrecognized. So it is already there in the books of accounts or it is not there in the books of accounts. The companies can decide to protect assets and liability which are already in the balance sheet or certain assets and liability which will get created at a future date, so they're not recognized in the financials today. For example, when I look at the concept of unrecognized, when I look at the example of unrecognized assets and liability, I would say the concept of unrecognized asset liability could arise on account of two factors. The concept of unrecognized asset liability could arise on account of two factors. One is called a firm commitment. So one is called a firm commitment. And the other one is called highly probable. The other one is called highly probable forecasted transaction. Highly probable forecasted transaction. Let's understand this. So we understand that if there is any unrecognized assets or liabilities, then in this particular case, we need to see that that unrecognized asset liability could be on account of firm commitment. For example, I as a company have already entered into a deal to buy a machinery 6 months later. So the machinery is not in my balance sheet. But I fear that the exchange rates may massively increase, due to which there will be too much outflows to buy that machinery. But it's a firm commitment. In any case, I've already contracted with another party. I've already entered into a transaction where I told them that I'm going to buy this machinery at a future date. So there is already a commitment which is made. It's a firm commitment which you need to honor at a future date. And it is only that once you honor the transaction at a future date, the asset and liability will get created at that date. Or there is a possibility that you have not entered into any kind of commitments as of today. You don't have any contracts entered into, but there is a highly likely chance of the transactions occurring. I may not have entered into a commitment to buy a machine, but I'm definitely planning to buy a machine, and there is, highly likely chances that I'll buy the machine in the next 6 months. And therefore, I know that the exchange rates might become adverse and I'll end up paying too much of cash outflows to buy the machine. So therefore, I may plan to hedge those assets which are not even appearing in the balance sheet of the company. So I may be planning to take a loan, for example, but I'm not committed to take a loan. So in those cases, the companies is facing a risk, maybe the challenges in terms of the exchange rates moving adverse, and therefore you face a challenge. So the companies can decide optionally that, okay, I want to protect the asset liability already in the balance sheet. I want to protect the asset liability which is not in the balance sheet, but there is something which is a forecasted transaction probable to occur. Or there is a commitment which I've already entered into. So I want to protect that asset liability in the balance sheet or may not be in the balance sheet. That's one. The second is that, when you're considering the hedging instrument, you can say it is the tool. It is the tool with which I am going to protect myself. The question rises, what is the tool with which the protection is done? Generally, the protection is done with the help of what we call derivatives. So the tool which we are going to use in terms of protecting ourselves is going to be derivatives. So the company would enter into a forward contract, a futures contract, an options contract, or maybe, swap arrangements wherein they will enter into derivative contracts to protect the hedge item. So what you're trying to protect is the hedged item. The protection is with the tool which is called a derivative in nature. And then So this is, I would say, generally, you will use derivatives for this particular purpose. The next is, once you've identified the two, then you need to decide, in this particular case, we need to decide what is called a formal documentation. What is called a formal documentation, and also deciding what is called the hedge effectiveness, and also deciding what is called the hedge effectiveness. So the company is required to do a formal documentation of its hedging policy. Why is the company entering into hedging? What is the risk policy of the company? Because we need to understand the need of hedging in a company. You will, since it is optional, the company would be required to do a formal documentation identifying, what is the policy of the management in terms of hedging a risk. Why are they entering into this kind of hedging? So the formal documentation needs to be done. And the documentation is also required to be done for the reason that once hedge accounting applies, many of the normal accountings will take a back seat. Now, when I say, when I say that many of the normal accounting will take a back seat, that we'll understand once we come to the more nitty-gritties of accounting. But apart from this, the most important factor is looking at what is called hedge effectiveness. Now, hedge effectiveness means that if the company decided to enter into the hedge, then it should be able to prove that the loss in a given situation through a derivative is almost covered, almost more than 90%. In Indians, we are not given any percentages of hedge effectiveness, but generally we believe that, if you want to conduct a hedging, your losses in a given situation because of that asset or liability is going to be covered by the derivatives at least around a 90% or more than 90%. Now, what do we mean by hedge effectiveness? That we'll understand. So the company should be able to conduct a test and identify that through the derivatives, they will be able to protect their losses at least to the extent of 90%, which will arise on the asset or liability. And once you've done the step number 3, then comes the step number 4, where you need to decide the type of hedge. Then you need to decide the type of hedge. Now, from an examination point of view, I think it will be an easy exercise to identify the hedged item. It will be an easy exercise to identify the instrument. The documentation's parameters will be given. Even the type of hedge will be given. There are basically two types of hedge. One is called a fair value hedge, and the other one is called a cash flow hedge. Though there is another hedge also, which is called net investment in the foreign operations, but we're not getting into that. So we're keeping our discussions limited to the two kinds of hedge. One is called a fair value hedge, and the other one is called a cash flow hedge. So managements may decide to apply a given hedge based on their perception. So it is quite possible. That in a given situation, a given management says, I want to apply a fair value hedge. In another situation, the same situation, another management says, no, I want to apply a cash flow hedge. So what is the kind of hedge, whether we are going to apply a cash flow or a fair value hedge, that would also be given in the question, that which hedge are we applying. And then finally, once you've zeroed down, then comes the accounting in terms of the fair value and the cash flow hedge. So to put it simply, the concept of hedge accounting is based on a 5-step model. Get the item, the asset liability, recognized, unrecognized, which you want to protect. Then get the derivatives with which the protections will occur. Do your formal documentations and check whether the hedge is going to be effective for you. You will be able to protect yourself against the gains, losses. Then decide on the kind of hedge, the type of hedge you want to apply, and then do the accounting treatment of the hedge. Our focus will now be on the accounting aspect. How does a fair value hedge and how does a cash flow hedge gets accounted? That would be the focus. But I think first we need to give you a break at this stage to relax your minds, and then we'll come on to the journey of understanding how the fair value hedge and the cash flow hedge accounts for. We're taking practical examples to illustrate the concept of fair value and cash flow. Fair value hedge is pretty simple and straight. Cash flow hedge has got a little more technicalities, but I think we'll take an example to illustrate how the accounting gets done. Right, friends, so far so good. So I think it's time to give you a little break, 10-12 minutes, and then we can commence back on the journey. Okay, thank you. You had a relaxation of mind to get some more inputs coming in through. Okay, I think I'm getting a message, sir. I'm not able to see the class 1 to 3 notes on the portal. Yes, they are all uploaded on the portal. Maybe you can check it because I uploaded myself. So I think the notes are definitely there. Okay, so let's now come back on the accounting. So we had a 5-step model, but I think now I need to expose you on the accounting for a fair value hedge and the accounting for a cash flow hedge. So let's first expose on the fair value hedge. So let us see what is the accounting as far as a fair value hedge is concerned. Now, fair value hedge is pretty simple and straight indeed. So I think I'll just conceptually give it to you with an example. There is nothing much which we need to understand in terms of a fair value hedge. Now, the only thing which you need to understand on a fair value hedge is that there is a hedged item on one side and there is a hedging instrument on the other side. Now, I don't know if I gave you the concept of squaring off. Did I explain you the concept of squaring off in terms of derivative? That how does a derivative help you in terms of hedging? I don't know. When I explained the concept of derivative, did I tell you about the concept of squaring off and the concept of that offsetting gains and losses which occurs through a derivative market? No. Okay, so I think let's do one thing. Let's first, I think, give you some insight on the derivative market so that we are able to understand and appreciate the logic as well. So let's take a small example. Let's say this is the stock market, and let's say this is the derivative market. So we've got two markets. One is the stock market and one is the derivative market. So let's look at the example carefully, and you'll get the concept of hedge effectiveness also with this example. Now let's consider that we bought, let's say, 10,000 shares of, let's say, company XYZ Limited, and this is bought at the rate of, let's say, 150 per share. So the company made an investment of, let's say, a total of 10,000 shares at the rate of 150 per share. Now, what is my apprehension is that the value of the shares will go down. So I'm feeling that there might be a fair value decline. So there will be a fair value loss because of decline in the price of the share. So my anticipation is that the price might reduce, and therefore I want to protect myself. Now, what I can do in the derivative market is today itself, I can enter into a contract in a derivative market where I could, let's say, sell futures of this particular stock. So what do I do? In order to do the protection, I sell futures. I sell the futures contract for the same shares. Let's say I took the same number of contract size, 10,000 shares, and I am able to sell, let's say, the futures 10,000 shares, let's say at the rate of 150 itself. Though let me tell you one thing and remind you again. The derivative market derives its value from the underlying asset. So logically speaking, the value in the derivative market is derived from the stock market. So the values may not 100% be the same. In this case, the value in this market is 150. So in this case, the value need not necessarily be 150. It can be maybe slightly more than 150. It can be maybe slightly less than 150. But to understand the example, I'm taking the same value intentionally. I'm not saying that this 150 will always be the same, what is there in the stock market. But, just to keep it safe, I want to consider that, let's say, the prices are same in both the markets, in the stock market as well as in the derivative market. Now, one thing which you need to be very careful, let's say the price in the market drops to 120. Now, one thing is very clear that the price in this market will also drop. So one thing you need to be very clear that if the price in the stock market goes up, the derivative market will also go up. If the price goes down, the value in the derivative market will also go down. The movement in terms of whether it's an increase or whether it's a decrease is common to both the markets. You cannot say that if there is an increase in this market, there will be a decrease in this market. No, it's an increase, it's an increase, it's a decrease, it's a decrease, but the percentage movement may not be same. The fall in the stock market may be, let's say, 20%. The fall, let's say, in the other market might be, let's say, 17%. Or the fall in this market is 20% in stock, but let's say in the derivative market, it might be, let's say, 25%. So the percentage variations may not match. The percentage variations may not match, but one thing is very clear, that in terms of the movement, the direction is same. So one thing which you need to keep in mind is that if you look at the directions of both markets, if you look at the directions of both the markets, the direction of both the markets is always same. It is always same. The percentage change may be different. The percentage changes may be different, that's fine, but the movements of both the markets will be same. So one market falls down, the other market will also definitely fall down. Now let's say this also went to 120. Now let's understand what is happening in terms of this market. Can I say the price of the share went down? So there is a loss to the extent of 30 rupees per share into 10,000 shares, which you suffered in the stock market. But in this case now, the price went down to 120. Now, generally in a derivative market, what we do is what we call the concept of squaring off. That is called cash settlement. So in this market, we need to do what is called cash settlement. Generally, I'm not saying that physical settlement is not possible, but generally a cash settlement is done. And this is called the concept which is called squaring off. That's what you're going to study in SFM as well, that what we do in a derivative market is what we do squaring off, which is nothing but it's a cash settlement. Now, what is the squaring off? You need to take an opposite position to square off, to set off the transaction. If you said that you will sell the futures, what do you need to do? You need to now buy the futures. So you need to take an opposite action in this particular case. In this case, if you say you sell the futures, now to square off the transaction, you need to buy the futures. Now imagine that if you buy at 120 and then you sell at 150, then you are going to get a gain to the extent of 30 rupees per share into a total of 10,000 shares. Now you can see a perfect input. The perfect input in this case is the loss in the stock market is exactly equal to the gain in the stock market. And this is giving you what we can say an offsetting advantage. This is giving you an offsetting advantage. The gain in one and the loss in the other market offsets each other and your wealth is protected. Because the stock market price went down to 120, you suffered a loss on the portfolio to the extent of 30 rupees per share, but then you get a gain in the derivative market to the extent of 30 rupees per share. And that's the power of the derivative market. Now, in my example, the gain in the derivative market exactly equals the loss in the stock market. That may not be true. Because as I said, the percentage change in both the markets might be different. So it is quite possible that you get a gain in a stock market and you get a loss in the derivative for sure. The gain here will be loss. The loss here will be a gain. But the gains and losses may not exactly match. In this case, if it exactly match, we can say the hedge effectiveness is 100%. Because you've been able to absorb the entire losses in the stock market. So we can say the hedge ratio, the hedge effectiveness is 100%. Let's say, for example, if you would have been able to recover, let's say 24 is the gain per share. I would say you're getting an 80% hedge effective in that case, which is not great. Because we want the companies to apply hedge accounting if they're able to prove the effectiveness to at least around a 90%. But nowhere it is given in the Indies that 90% is supposed to be the parameter. But if you look at, for example, the US gaps, they prescribe percentages of around 90-95% range, where they say that you should be able to recover 90 to 95% of the losses in this market through the derivative markets. Then only it's a good point applying a derivative market. So that is what is called the concept of hedge. Now, the biggest advantage of hedge is that when you enter into a derivative market, the gains and losses, or the losses and the gains will always give you an offsetting advantage. But what is important now to understand is that if you look at the accounting, this is the hedged item. There is hedged item on one side, and there is hedging instrument on the other side. Now see what the accounting treatment is being prescribed in terms of fair value hedge. The hedged item will be measured at FVTPL. The hedged item will be measured at FPTPL, which means the relevant standard applicable to the item will be overridden. The relevant standard applicable to the item will be overridden. So if you bring, for example, inventory under the purview of hedge accounting, Ind AS 2 will not be applicable. Inventories will not be taken at cost NRV, whichever is less. Inventories will be taken at fair value with any changes in fair value in the P&L, gain or loss, whatever. For example, if you bring a property, plant, equipment under the purview of fair value hedge, Ind AS 16 will no longer be applicable. You're not going to consider a cost model or a revaluation model. The PPE will be taken at a fair value. Any changes in the fair value, gain or loss in the P&L. I hope you heard it correct. So the moment you bring the hedged item, the moment you bring the item under the purview of hedge accounting, fair value hedge, the hedged item, relevant standard becomes inapplicable. Now you're not going to consider inventory as per Ind AS 2. You're not going to consider your PPE as per Ind AS 16, but it'll be valued at a fair value through P&L. Gain, losses, all captured in the P&L. And in any case, the hedging instruments will be taken at FPTPL. So what is the good advantage of doing this? The good advantage is the gain here will match the loss here. The loss here will match the gain here. And with this, the company is going to get a good offsetting advantage. There will be an offsetting advantage which will occur to the company. Had you not taken a hedge accounting, your derivatives would have been taken at FPTPL in any case. Because derivatives, you've already seen, whether it's a derivative investment or derivative liability, it's all at FPTPL. So if you do not apply hedge accounting, this changes goes in the P&L, increasing the volatility in terms of the P&L. And this changes will be accounted in accordance with the relevant standard. But when you bring it under the umbrella of hedge accounting, the fair value gain on the item and the fair value loss on the instrument, the fair value loss on the item, the fair value gain on the instrument, this is going to give you an offsetting advantage. So volatility in terms of P&L gets reduced. So the company is already entering into contracts in a derivative market. Let's tell them that, why don't you enter into a hedge accounting? And if you've already entered into derivative contract, consider the hedge accounting and bring those hedged items under the purview of this accounting. So you get a good accounting advantage. And that is going to offset the gains and losses, reduce the volatility in the P&L. I hope you got the concepts clear on that. Now comes a very interesting input further to give you. Okay, so but in such cases, the entity may not generate profit as the hedge instrument will offset it. Well, I think then, you definitely lose that advantage. I agree. Now you are saying that I got a gain. Simply, I would not have entered into a derivative market. I would have captured the gain. Risk uncertainty is attached to the future. How do you know that you're going to get a gain on the hedged item? So if you're trying to protect yourself, the protection will definitely come at a cost. So I think I agree with you that the company might say, oh my God, why did I enter into the derivative market? Because I would have got this gain only because now I entered into a derivative market. I'm getting an equal level of loss or maybe more than that, or maybe less than that. So that risk you're definitely occurring, but you never knew that the prices will go up or the prices will go down. So because of that risk which you were facing, you were trying to protect yourself. And in the entire, inputs of trying to protect yourself, you're going to lose the opportunity of getting that gain. But what happens if there is a loss? You protected yourself, right? Okay, so this is one. Now, let's give you another interesting input in this case. and that is what is called an exception. Now, you will love the exception which is given in the standard. The standard setters were very interested in one thing. Equity investments at FPTOCI. Oh my God, if you bring them under the concept of hedging, I'll overrule the hedge accounting itself. So the exception is if you've got equity investments at FPTOCI, that is NR. So if a company has got equity investments at FPTOCI NR, the hedged item will be accounted at FPTOCI NR. The derivatives will also be accounted at FPTOCI NR. No FPTPL. No FPTPL. I love this exception. See the level of protections they've given to the equity investments. Unrealized gains and losses, OCI. Realized gains and losses, OCI. Impairment not applicable. Even if you bring it under the ambit of hedging, you got to take the fair value changes in the OCI and not the P&L. Because the basic rule is hedged items are measured at a fair value through P&L. Hedging instruments measured at a fair value through P&L. But the only exception is equity investments at FPTOCI. If you bring the equity investments at FPTOCI, your fair value changes of the item, the fair value changes of the derivative, both will enter the profit and loss of the company, both will enter the OCI of the company. That's creating a wonderful exception where the standard setters did not want anything relating to equity investments entering the profit and loss. Safeguarded them from realized, unrealized gains, safeguarded them from impairments, safeguarded them from hedge accounting all throughout. That's a wonderful one. Okay, so this is one inputs done, that is fair value. So if equity investment is also FPTPL, no. This exception is only, as I said, to equity investments FPTOCI NR. Why would you hedge an equity investments at FPTPL per se? Because the fair value change in any case is going to the P&L. So this exception is applicable only for equity investments measured at FPTOCI NR, where the fair value changes on the instrument and the item both in OCI. Correct. Okay, so this is on the fair value hedge. And I think you may not even get a question on the fair value hedge because this is too simple. Because all you need to do is just put the fair value changes in the P&L for the item and the instrument, and that's the end. Now comes a little complicated accounting, and that is the accounting for a cash flow hedge. Now this is interesting. This is interesting to understand the concept of accounting as far as a cash flow hedge is concerned. Now watch this. This can be confusing. So I'll take an example to illustrate this to you. So this is the hedged item. So we've got the hedged item on one side and we've got the hedging instrument on the other side. Now, let me remind you, we're talking in terms of cash flow hedge. We're not on the fair value hedge. The fair value hedge was simple and straight. Now we're talking in terms of the cash flow hedge, how the hedged item and how the hedging instrument is going to be taken care of. Okay, now watch this carefully. As far as the hedged item is concerned, the relevant standard will keep applying. We will apply the relevant standard, no concept of fair value through P&L. You will not touch the hedged item. The hedged item continues to be accounted as per the relevant standard. So the usual accounting continues. There is no changes at all. The usual accounting continues for the hedged item. Now comes the hedging instrument. Now, in this particular case, what I'm going to do, see this carefully. I will calculate the fair value changes of the hedged item. So, but you said that the fair value change is not to be accounted for. Yes, I said that. I will only compute. I did not say I'll account. I will calculate the fair value change of the hedge item, and I will calculate the fair value change of the hedging instrument. Now, please hear this carefully. I'll explain in simple words to you. So let's say the fair value change of the hedged item is, let's say, 20,000 and the fair value change is 18, or let's consider this as 20 and let's consider this as 25. Now, tell me which is the umbrella. So the hedging instrument is the umbrella. Very good. Tell me now, friends, I want to get this answer from you. In the first case, your fair value change of the umbrella is less than the fair value change of the item. Is the umbrella small or is the umbrella big? Are you able to protect yourself completely or you're not able to protect? Is the umbrella big or is the umbrella small? Tell me. This is important to understand. That's right. The umbrella is supposed to be small in nature. If your umbrella in this case is small, I have no problem. But tell me, in this case, is the umbrella size small or big? The fair value change of the item is 20. Your umbrella is protecting you against 25. Big umbrella, not allowed, sir. So in this case, your umbrella is big. Now see what is the accounting treatment prescribed. So you will compare the fair value change. You will compare the fair value change of the item and the instrument and decide umbrella big or small. Now see what you're going to do in this case. Watch this carefully. The standard setters decided in this case when the umbrella is small and when the umbrella is big. So what did they decide? I have to account for this 18 and I have to account for this 25. We need to account for the fair value changes of the instrument. Remember, we need to account for the fair value changes of the instrument. If the umbrella is small, it's fine. This entire 18,000 will be taken in OCI. It is called that this is the effective portion. This is called that it is the effective portion of the hedge. This portion is supposed to be effective, so you can take it in other comprehensive income. And in terms of other comprehensive income, this will be basically taken to SOKI, and this will be taken to SOKI tab number 3. And in terms of tab number 3, we'll put it in cash flow hedge reserve. So this entire money, there is this 18,000. Since the umbrella is small, we will put this money in statement of changes in equity in tab number 3. And this will be put under the nomenclature CF, cash flow hedge reserve. So this money is going to be OCIR. This money is going to be OCIR. Now let's see the other case. In the next case, we can see the umbrella is big. How much big? 5,000 big. So what I'll do, to the extent of 20, this will be captured in the other comprehensive income and the excess size that will go in the P&L. This is called ineffective hedge. This is called ineffective hedge. This is the ineffective portion. Why did you take a bigger umbrella? Sir, but why? You see, if you're taking a bigger umbrella, your extra derivative should be accounted at PTPL. If companies are asked to put the entire 25 in OCI, everybody will carry big umbrellas, na? Are you getting my point? So everybody will carry big umbrellas, because if you know that you will tell me to put this entire 25 in OCI, my EPS is not affected, if I'm going to put it in OCI. So the standard setter said, sir, you can take equal size or a lesser size umbrella, not bigger size umbrella. If you're taking a bigger size umbrella, then that extra fair value change is something which you entered into extra derivatives. Please put it in the profit and loss. So the companies will be allowed to take this 20 in the OCI because it is effectively covering the item and the excess. And the excess is called the ineffective portions, which will be taken in the P&L. Did you get the point? I'll just consolidate the inputs once again. So what you need to do in terms of cash flow hedge, in terms of the cash flow hedge, you will consider the hedging instrument. You will calculate the fair value changes of the item and the instrument both. You will calculate the fair value changes of the item and the instrument both. So when you take the fair value changes of the item and the instrument, compare and decide umbrella small, umbrella big. If the umbrella is small, your fair value changes of the instrument is equal or less. The umbrella is small. If it is small, you'll put entire money in OCI. It's an effective hedge, which goes in cash flow hedge reserve in tab 3, and it will be put into the P&L. This amount will be put into the P&L when the hedged item is sold. When you're going to sell the hedged item, I'm going to put this amount in the profit and loss at that particular stage. And if the umbrella size is big, to the extent of that bigger size, 20 goes in OCI effective, 5 is the excess that goes in the profit and loss. Bigger umbrella, the excess umbrella not allowed. So you're going to take that excess in the profit and loss. Clear with the position? Okay, so this I think takes care of the accounting treatment as far as a cash flow hedge is concerned. Okay, I'm getting a question. So giving it to P&L, then EPS is effective, and then you can give dividends as well. Well, in any case, if you are saying it's an effective hedge, remember one thing. In this particular case, the effective portion is going to the OCI. It's not available. The ineffective portion is going, but that's fine. But if the company is carrying out hedge accounting, let me also tell you, too much over effective hedge also, the auditor will tell you to discontinue the hedge accounting. Because generally, practically what is taken is the hedge ratio should be something, between 90 to 125% maximum. So if the company is going to get some huge gains out of derivative market and you're exposing yourself to over hedging of more than 125%, I'm going to stop your hedge accounting there and then. So it's not that you're going to, use the advantage of using this hedge accounting till perpetuity. So the company's auditors is also liable to see that the company's hedge accounting is, ineffective. The day it becomes ineffective, you tell them out. Your hedge accounting is going to be discontinued in that case, right? Okay, and then he said, so companies will always take a big umbrella for dividend. I think you got the answer on that. Okay. So this is the inputs in terms of accounting for a cash flow and a fair value hedge. So I think if the time permits, I'll maybe come to a practical illustration on this, but conceptually, I've given you this input. Now, I need to take some time to spend now on my fourth issue, and that is the concept of embedded derivatives in nature. Okay, so I think let's go to the next issue agenda now, and that is the concept of what is called embedded derivatives. It is called embedded derivatives. Now here I need to explain you some inputs and then explain you the accounting as well. So the special issues we have covered, derecognitions much in detail, impairments we have not gone too much detail but relatively kept it simple for understanding, and hedge accounting I've kept it simple for understanding because I don't think so there has been much questions, any comprehensive questions coming in the exams on that area. Now let's come to the fourth and the last issue on the standard, which is the concept of embedded derivatives. And for this, I think I need to take you to the study material again. So there is a particular unit in the study material, unit number 4, which explains the concept of embedded derivatives. So let me just come to the inputs on a very interesting chart. Oh, yes. So I'll first explain the process to you in terms of embedded derivatives. Then I think we'll look into an illustration, understanding how this accounting is done. So let me just first make a walkthrough on this particular chart. So this is on the unit number 4 in the study mat. So let's have a look. I think somebody was asking me a question in the last session, and I said we'll be coming to this agenda very soon. So here we come on that agenda. Now, this is what is called the accounting for embedded derivatives. Now, I'll make it simple. Any guess I'm going to convert this chart into how many steps? You know me so well now, so I think it's a good question to ask you. What do you think I'm going to convert this chart into how many steps? Let's see how many of you can answer this. 3 step, very good. So I think now you know me very well on this 3-step model is what we're going to cover now. Let's have a look now. First, let's read the input. It says, does the hybrid contract contain a host that is an asset within the scope of Index 109? Oh my God. You will say, so what does this mean? I'll give you a simple example to understand. The step number 1 is to see that the contract is hybrid in nature. The step number 1 is to see that the contract is hybrid in nature, and we need to see hybrid in nature means that it has got a host and there is an embedded derivative. Let me explain. Let's say, for example, I enter into the contract to buy a, let's say, PPE at functional currency. Mind the language, mind the words. I entered into a contract to buy a PPE at a functional currency. Second, compared to this, I entered into a contract to buy a PPE in a foreign currency. Now, the moment you enter into the contract to buy a PPE at a foreign currency, there is an exchange rate which is involved in this transaction. And the fluctuations in the exchange rate could lead to changes in terms of the value at which you will be able to buy this PPE. So if you remove the foreign currency out of this transaction, then that fluctuation will not happen. So we can say a good example of understanding hybrid contract is that imagine a transaction, there is a purchase of PPE in functional currency. There is no fluctuations. There is no fluctuations, so there is no derivative. But if you say that there is a contract to buy a PPE in a foreign currency, because of the changes in the exchange rate, the purchase value of the machinery may go up or it may go down. The volatility could impact the purchase of PPE. Now, it will take me some time to explain you the logic of why the standard setters wanted to segregate this derivative embedded in the instrument, because once we do the practical illustrations, I will compare the knowledge in terms of ICAI and in terms of Indias to get the essence of why did they decide all that. But we can say the first thing is to identify that the contract is hybrid in nature. For the time being, you can consider 2 kinds of contracts. A contract to purchase an asset in a foreign currency, a contract to sell an asset in a foreign currency that could lead to the presence of foreign exchange fluctuations, and we will say it is hybrid contract in nature. Then you go to the step number 2. It says it's a hybrid contract. It's like step 1 that contains a host that is within the asset scope of this. Now, what you need to do in step number 2 is put across a question step number 2A and step number 2B. Step number 2A and step number 2B. Now, what is the step number 2A and B? You need to see that as far as the host is concerned, number 1, is it an asset? And number 2, is it within the scope of the standard or not? So there are 2 questions which you need to put across. You need to put across a question that the host buying and selling a machine, is it within the scope of the standard? Technically not. Because buying and selling the asset PPE is a non-financial asset, so it's not within the scope of the standard. It is definitely an asset, but it's not within the scope of the standard. So you need to put across 2 questions. Is it an asset? 1, within the scope of 1092. So this is like 2A and this is like 2B. Oh my God, the first question put across in 2 steps. So you will see that is the host contract number one an asset, number two within the scope of 109. Now the answer could be a yes or no. If you say no, separate the embedded derivatives provided certain conditions are met. Provided certain conditions are met. If you say the answer is yes, then don't separate the embedded derivatives in this case. So these are the conditions, condition 1, condition 2, and condition 3. So these are the three conditions which are given. So I think in this particular case, now if you say, in this case, if you say yes or if you say no, if you say yes, then the embedded derivative is not segregated. If you say a no, we go to the step number 3. We go to the step number 3. And in terms of the step number 3, you need to evaluate the three conditions. Now, in the study material, they spent a good time explaining you how to evaluate those three conditions as well. Well, I guess so far I've not seen questions where the examiner is asking you to evaluate those conditions because they can be very subjective evaluations. But we need to know those conditions because those conditions, at least theoretically, could be asked maybe in terms of MCQ. So let's have a look at those three conditions. The three conditions is economic characteristic and risk of the ED is closely related to the host. Now you'll say, so what does this mean? I just call it as economic characteristics and risk, ECR. I call it as ECR, economic characteristic and risk of ED and the host are closely related. If you say yes, they are closely related, no segregation is done. The second one is a separate instrument with the same terms as ED would meet the definition of derivative. If you say no, then the ED is not segregated. The third is the hybrid contract measured at FPTPL? If you say yes, we don't segregate. If you say no, the embedded derivative is segregated. Sir. Let's make the life simple. Let's not get into the nitty-gritties of those conditions. I'll just give you a basic common sense on that. Let me, I think, pen this down simultaneously. So we're working on the concept of ED. We're working on the concept of ED. Let's put it here only. So we can say in terms of embedded derivative. In terms of embedded derivative. Now, what you need to consider is a three-step. Now, what are the three steps with the conditions? The three-step number one. The first step is that is it a hybrid contract? Is it supposed to be a hybrid contract? Now, how do you identify that it is a hybrid contract? As I said, you can consider from the examination point of view, anything, let me put it simple words from the examination point of view, anything which could fluctuate the inflow outflow out of that asset liability. Anything which could fluctuate. As I said, if you're going to buy a machine in functional currency, you're going to pay a fixed money. But if you say that you're going to buy or sell a machinery in a foreign currency, that could lead to fluctuations because of exchange rate fluctuations. So wherever you see that variability could arise on account of a particular factor, and putting it simple to you, wherever you see that a variability could arise out of a particular factor, the moment you see that a variability could arise out of that factor, it means it is hybrid in nature. So more or less the examples are, you can say the purchase of asset in a foreign currency, sale of the asset in a foreign currency. So any element in a contract which could lead to variability in terms of inflow, outflow, that will make the contract hybrid in nature. So I think I'll put it like this, that this hybrid contract is some element. There is some element which causes variability. Some element which is going to causes variability, then you can say, yes, it would be a case of a hybrid contract. Now, once you decide, is it a hybrid contract? The answer is yes, or the answer is a no. If the answer is a no, then this concept does not apply. Then this concept is not applicable in nature. Okay, I'm getting some questions. And this is, okay, that was an answer. Okay, Indus 1621, that's right. Okay, so now if you say a yes, then what I'm going to do, I am going to go to the step number 2. So once you go to the step number 2, in step number 2, you need to put across 2 questions. And the 2 questions is the host, that is, we are looking at without the ED, we are looking at the host, which is without the ED. Purchase of a machine is the host, and the foreign currency is the ED. So you can say the host buying a machine, that is the host. So is the host an asset? Number 1. And there is a plus within the scope of financial instruments, that is Index 109. So there are 2 questions, that is it an asset, plus is it within the scope of the standard? So the answer in this case is either a yes or the answer is a no. So if you say yes, it is an asset and it is within the scope of the standard, then in that case, no segregation of ED, no segregation of embedded derivative. And if the answer is a no, you go to the step number 3. So in this case, the step 2 is a bit crucial to find out that is the host an asset within the scope of the standard. Let's, I think, first give you some inputs at this stage. So when I say it is an asset within the scope of the standard, can I say it should be typically a financial assets? Is that right? So when I say that it is a host is within the scope of the standard, typically financial assets are assets within the scope of the standard. So more or less, you can say more or less non-financial assets, liabilities, whether they are financial or non-financial, can I say they will never pass this step? You will always get an answer no. So you can say per se, if there are liabilities, financial, non-financial, per se they are non-financial assets, so they will get into this no. And if it is a financial asset, they will typically get into this yes. So if you say it is a financial asset within the scope of the standard, ED not required to be segregated. But if you say that it's not an asset, maybe it's a financial liability, it may be within the scope of the standard, but it's not an asset. So if it is a financial liability, non-financial assets, the answer is you go to the step number 3. And then finally, when you come to the step number 3, we need to evaluate 3 conditions. We need to evaluate 3 conditions in this case, and all these conditions are required to be met. So all are required to be met. So all the conditions are required to be met. So we've got 2 possibilities. One is that all are met. All the conditions are met. That is possibility 1. Or we can say any one fails. Any one or more than one fails in this case. Now, if you say all the conditions are met in this particular case, we will segregate the ED. We will segregate the embedded derivative. And if you say any one or more than one fails, then no segregation of ED. No segregation of embedded derivative, then the entire instrument, then the entire contract is accounted. The entire contract is accounted using FPTPL. In this case, we apply the concept of FPTPL. In this case, we will segregate. Now, what are the 3 conditions to give you conceptually? So just to give you those 3 conditions without getting into the nitty-gritties, because each conditions can involve a lot of evaluations of parameters, but just to give you those conditions, the first one is ECR. That is called economic characteristics and risk. Economic characteristic and risk. So what is important is that ECR, economic characteristics and risk of host, and ED are not closely related. They should not be closely related. So if you want to meet the condition, it should not be closely related. In simple words, you can say the host equity derivative, equity or debt, the embedded derivative, equity or debt, either equity, closely related, debt, closely related. One is equity, one is debt, not closely related. So basically looking at the ECR is looking at the characteristic that what is the nature? Is it got an equity or a debt characteristic? If both of them got equity characteristics, not they are closely related. So one should be equity characteristics, one should be a debt characteristics, then they are not closely related. So this is basically looking at the characteristic from the point of view of the equity and the debt characteristics. The second condition is ED meets all three parameters of derivatives. ED meets all three parameters of derivatives. You already know what were the three parameters of derivative, that it is value depends upon the underlying asset. Then we said initial investment negligible or zero, and there will be future settlement. The ED evaluated separately meets all the three characteristics of a derivative. And we can say the third one is that the company is not designating. The company is not designating the contract. The company is not designating the contract at FPTPL. So the company did not decide to designate the contract at FPTPL. So we need to see three parameters. The economic characteristics and risk should not be closely related. The ED should meet the parameters of a derivative. And number three, the company is decided not to designate the instrument at FPTPL. If these three conditions are met, I'll segregate the ED. If they are not met, I will not segregate the ED. Now, if you want to get into more details regarding these three conditions, some examples are given in the study which illustrates all that inputs. I'm not getting into that kind of technicality because those things are not even touched in the exams. And as I said, there is no dearth of doing your PhDs on the financial instruments. The standard is big and huge, and there is no dearth of that. But I think we have come a long way. We have covered a lot of things which are there. So I think even if you're able to cover up all that, it takes care of everything on a decent levels in the exam. Okay, so I think this is the input conceptually, theoretically, how the evaluation is done, whether we're going to segregate the derivative or not. Now let's look at a question where we reach the three steps and how does the accounting gets captured. Let's have a look. So I'm carrying a small little question with me where I'm going to explain the accounting of this ED with a very simple example. Did I miss out on that question, I guess? Okay, I'll maybe show that question to you separately on the screen, I guess. Let me just, I think, share a small little question to you on the screen. Just a second. So this is from the study material itself. I'm just going to share a small little question to you. Just give me a minute. Or maybe I can give you the facts of the case directly. Okay, let me do one thing. Let me, I guess, give you the facts of the case directly through an example to illustrate the accounting. So this is one of the illustrations which are there in the study material. So let me, I think, share that example to you. So I'll give you the facts of the case. This is an example on an ED. So let's consider that on 1st April, a company entered into, so let's say on the 1st of April 17, a company entered into a contract, and let's say this is to buy solar panels. So there was a contract to buy solar panels on 1st April, and it says that this is from after 6 months. So that is, we're going to buy this after 6 months on, let's say, 30th September 17. So we entered into the contract on the 1st of April to buy. It says a contract at the rate of 6 months later, and we are given the purchase price. We're given the purchase price of this particular solar panels is, let's say, $50 million. Let's say this is $50 million. And let's consider that the functional currency of this company is Indian rupees. So let's consider that the functional currency of this company is INR, that is Indian rupee. Okay, and then I am also given the exchange rate. Let's say the conditions all are met, and we're also given the exchange rates as well. So we are given a few exchange rates in this case. Number one, let's say I'm given the exchange rate on 1st April 17. That is what you can call a spot rate. And let's say the spot rate is given $1 at the rate of 60 rupees. And let's say I am given a 6 months forward rate. I'm given a forward rate for a period of 6 months entered today. So we're given $1 is, let's say, INR to the extent of 65. And let's say on 30th September, I am again given a spot rate. So let's say at the end of the year, end of the 6 months, the spot rate is given to me, it's $1.66. So this is the details of a very simple example to understand the concept of ED. So the company is entered into the contract to buy solar panels today to be purchased 6 months later. And this is $50 million in foreign currency, though my functional currency is INR. Exchange rates on 1st April and the forward rates and the spot rate on 30th September, everything is given. Now let's, I think, first of all, visualize the inputs. Is this a hybrid contract? Yes. The exchange rate is creating the variability, as I said. So it is definitely supposed to be a hybrid contract. Now, is it an asset? Yes, I'm going to buy a solar panel. It's an asset. But is it within the scope of the standard? No, it's not. Because in this particular case, this asset is a solar panel, which is a non-financial asset. And therefore, I am not in the scope of the standard. So we go to the step number 3. Assuming that all the conditions are met, the characteristics, ECR, the derivative parameters, designation not done, all conditions are met, which means the ED is to be segregated. Now let's see how the accounting of this ED will take place. So let's consider what is the accounting treatment going to be. Now, this is an interesting trick. Hear this carefully, because this is going to make your life simple. I always tell people, if you want to do the accounting for ED, what you need to do is break down the transactions in this way. See how the transaction is broken. The transaction is buy a solar panel in dollars. That is the original transaction, that you need to buy a solar panel in dollars. It is only because you're going to buy this in a foreign currency, there is an ED. Let's break it down. So what we're going to do, we're going to break this transactions in 2 parts. This is the first thing which you need to do, that break the transactions in 2 parts. I will say, okay, I will buy solar panels. I will buy the solar panel in, let's say, INR. The moment I say I'm going to buy in INR, the ED is gone. Because now when you say that you're going to buy in Indian rupees, there is no variability, no fluctuations which is going to take place. The ED is out. So in this particular case, but the transaction is dollars. So there has to be an outflow in terms of dollars. Because at the end of the day, there has to be an outflow in dollars. Now watch this carefully. When you put the transaction that you're going to buy these solar panels in INR, you are indirectly considering that there is a payment in INR. You are indirectly considering that there is a payment in INR, but this is a notional payment because there is going to be no payment in terms of INR as such. You are basically going to buy things in dollar. So when you say that I'll buy in INR, you are saying that I'm going to pay INR, but there is no actual outflow of INR. The outflow will be in terms of dollars. So there is a notional payment in INR. So what do we need to do? We need to correspondingly create a notional receipt. We need to correspondingly create a notional receipt of INR. So in order to cancel this transaction, we need to enter into a contract where you are able to show that there is going to be a notional receipt of INR. How will a notional receipt of INR arise? If you enter into a contract to sell dollars, then you will get Indian rupees. So we will create a transaction that we will sell dollars and receive INR. So let me tell you that we are assuming that this is a forward contract. There is no forward contract. There is no forward contract. It's just a notional forward contract which is created. Because you wanted to create a notional payment, so therefore to cancel, you need to create a notional receipt. So you said, okay, I'm going to sell the dollars and I'm going to get the Indian rupees. So a notional payment in INR, a notional receipt in INR will cancel each other. So the first art, what you need to do is break the transactions in terms of two transactions. Break the transaction in terms of two transactions. Write down the transaction, buy the panel in dollars. Write it into two parts in such a way that there is no ED in the first part. So when you say, I buy the panel in INR, then there is no ED. But then I'm not paying INR. There is a notional payment which gets created because of this transaction. So you need to create a notional receipt in order to cancel the transaction. So think of a forward contract which results in a notional receipt. So when you sell dollars and you get INR in return, it creates a notional forward contract in this case. So now we're going to account for the transactions based on two transactions. Transaction one, that you're going to buy the panels in Indian rupee and you've entered into a forward contract. There is no forward contract, but we're going to do the accounting as if a forward contract is entered into. So in this case, now let's see the journal entries which we're going to pass in this case. If you would have entered into a forward contract, in this case, you would have first of all done the entry on the 1st April. On the 1st April 17, there will be no entry because the day you enter into a forward contract and you square off the transaction, the fair value of all the contracts is 0. So the day you enter into the contract and a squaring off is done on the same date itself, the fair value is always 0. So no entries will be done on 1st April 17. Now we need to do the entry on 30th September. Now, in terms of 30th September, what do you need to do? You need to do a squaring off. What did you do? Let's go back. So what did you do in this particular case? As I gave you the example, we entered into the forward contract to sell dollars at 65. So we're doing a squaring of the transaction. So in the case of squaring of the transaction, we said we will sell dollars at the rate of 65 because we notionally entered into a forward contract to sell dollars and that is 65. So in this particular case, you need to square off by entering a opposite contract, that is, you're going to buy dollars, and the rate on 30th September is 66. So this is the forward rate, and this is the spot rate at which the squaring off will be done. So we will say that we will sell at 65, but we will buy at 66. So there is a loss of 1 rupee per dollar. So we're going to put the entry profit and loss gets a debit, and there will be a derivative financial liability which gets created. Because you've entered into a forward contract, though notionally, it is creating a notional. It is creating, you can say, a notional derivative asset or liability. So gain will create a financial asset derivative, loss will create a derivative liability that is there. So what is the amount? Let's see. So we said that we're going to buy the solar panels at $50 million. So in this particular case, I will put the entry 50 million into 1. So this is going to be $50 million into 1. So this comes to $50 million is the loss on account of the derivative contract. Now, we will buy this machine. We have to buy the solar panels in any case. So we'll put an entry for purchase of the solar panels. So another entry will be done. Solar panels get a debit. And this will be bank gets a credit. And this entry is going to be done, rather, I would say not bank, let's take it as creditors because we need to make some adjustments. So this entry will be done at a forward rate itself, though we did not enter into any forward contract. I'll give you the logics very slightly in 2 minutes' time. So we will enter this particular transaction at the forward rate, though I have not entered into any forward contract. But the purchase of the panels will be recorded at the rate of forward rate. So this is 50 million into 65, which is supposed to be the forward rate. So this is a notional entry accounting for a derivative, and then this is a purchase of the panels at a forward rate, though not entered into any forward contract. Now what am I supposed to do? Since there is no derivative contract, so this derivative liability and this creditors in this case will get adjusted. So we'll put the entry, the derivative financial liability gets a debit and the creditor gets a credit. So this amount is adjusted in the creditors. Now let's see the logic. At the end of the day, just forget about the question, just see the common essence. You would have bought the machine at 66, which is the spot rate on 30th September. So your payment is at the spot rate. Your creditors, if you take this 65 plus this one, your creditors are standing at 66 itself. You did not enter into any forward contracts. So your payments are going to be at the spot rate on 30th September. So you captured the creditors at the forward rate. You captured that difference on the squaring of transaction 1. So creditors in the book is standing at 66. But the machine, the machine panel is got recorded at the rate of 65. So that extra 1 rupee is got into the profit and loss. So you can see by segregating the ED, the asset got recorded at 65. The fluctuations in the exchange gain, exchange loss is not getting capitalized as a part of the panel. Had you continued your normal IGAP accounting, trust me, in the normal IGAP accounting, you would have captured the panel at 66. The panel would have got recorded at 66. The creditors would have got recorded at 66. By segregating the embedded derivative, what has actually resulted is that you've captured the excess, the gain loss in P&L. The panel is getting recorded as if the fluctuations in the exchange rate would not have occurred. So the net entry is that after the end of all the entries, you will see that the panel should get recorded at the forward rate. The creditor should get recorded at the spot rate, and any difference fluctuations, whether it's an exchange gain or loss, will get captured in the P&L. Why should the exchange gain or loss impact the valuations of the panel? So this is the essence why the embedded derivatives are segregated out of the hybrid contracts so that the exchange gain loss doesn't get added or subtracted from the cost of the asset. I know what I've said is all very technical indeed, but if you try to visualize, you'll get more inputs on that. All right, friends. So I think that takes care of now the two agendas on ED. We've done the parameters of segregating the ED. We've also done the accounting for the ED, all the special issues on financial instruments done. Now, my job on financial instrument gets over, but your job on financial instrument begins. Now, what you need to do is do a cumulative revision of all the lectures, 10 lectures on financial instruments, then do the questions in the study mat, in the past examinations, RTP questions and all. Get your strength on this particular topic. Trust me, you'll feel much, much more confident indeed. Right, friends. So I think that's all for the day. Let me see if there are any questions coming on your side. Some of the contract rate is 66, so solar must be reported at 66. No. You see, the main idea of this reporting is what? You're buying the panel at 66, agreed. So the creditors are getting captured at 66, that is one. But the main thing is, why would I tell the company to record the panel at 66? Reason is, the fluctuation of 65 to 66 is a pure exchange rate fluctuation. You know what was happening in the IGAPs in terms of accounting standard is, you pay 66, asset gets captured at 66, liability gets captured at 66. We realized that, in this case, what is happening, the exchange loss, which should technically enter the P&L. So I would put one sentence, just analyze this. So we are indirectly telling the company, had you entered into a forward contract, what would have been the position? You would have capitalized the panel at 65 and the remaining one would have gone to the P&L. So if the company did not enter into the forward contract, still give them the same kind of accounting. Had they entered into the forward contract, they would have capitalized at 65. I think I make sense on that, right? Because I want to understand that even if they would not have entered into a forward contract, if they would have entered in the forward contract, they would have capitalized at 65. So I want to bring them into the same position had they entered into a forward contract. Right, I guess you get your answer. So thank you very much for such a wonderful teaching. Thank you very much indeed. That's a pleasure. And now moving onwards in the next session, we'll be starting with the plethora, I would say plethora of consolidation standards. You've got India's 103, 110 and other standards coming in. So that's also going to be a comprehensive level of standards. So we'll ensure that we deep dive into the consolidation as well. Because just like financial instruments, even consolidation is supposed to be very, very important. I would say invariably comes in the exams every time in the exams. Right, friends. So I think that seems to be all good for the day. Thank you very much indeed. Right, friends. So time to say goodbye to you. So see you in the next session. Thank you very much. Please revise this standard in entirety. We'll start with consolidations in the next one. Thank you very much. Bye-bye and take care. Haji, thank you. Same to you.